Very good evening to everyone. I welcome you all for the second day revision crash course on financial management by our eminent faculty, Saravana Prasath sir. Sir has given the topic for today's session as leverage and capital structure. I hope you all will enjoy this session. Welcoming CA Saravana Prasath sir for this session. All the very best to all dear friends and a happy learning to you. Over to you, Saravana Prasath sir.
Thank you. Very good evening to all of you who have joined in live for this session on risk and leverage analysis, followed by cost of capital and capital structure as part of the discussion for CA final paper 8 financial management. In yesterday's session, we have talked about working capital management, all the short-term funds management, current assets and the current liabilities. In today's session, we will be going ahead with long-term funds management. The first of this is to understand what is the concept of leverage, and whatever knowledge we have in leverage, we carry it into the next chapter called as the cost of capital and the capital structure. May I request the slide to be made available online, please. Yeah, thank you. So here we are in relation to risk and leverage analysis. Now, generally, what is the meaning of leverage? Leverage is a factor. Leverage is a factor. Something which creates an advantage for an entity up to a particular extent. Too much of the same factor creates a risk. If it is favorable, creates an advantage, we call it as leverage. If that creates a risk, we call it as risk. If it creates a disadvantage, we call it as risk in simple terms. Now, there are two types of aspects with which we understand leverage in the context of a business. One is the fact that its fixed cost remain constant irrespective of the output level is an advantage. We call that as operating leverage. Another factor is that irrespective of the earnings before interest and tax, the amount of interest payment on debt is a constant amount. So consequently, if you earn more income, more EBIT, we are not obligated to pay more interest. We still pay the same interest. Therefore, correspondingly, we have an advantage for the shareholders. We call that as financial leverage. So let's learn more about leverage and how the computations are made, what are all the calculations we have to remember in this regard. We will start off. We will open with a question to understand the concept of leverage. The question is before you on the screen. Let me read it. Ashwin Limited sells 10,000 units of a product per month at a rate of 100 rupees per unit. 10,000 units per month into 100 rupees. So monthly sales is equivalent to 10 lakh, 10,000 into 100 into annual sales 12 months, 120 lakhs. This is the starting point we are aiming at. Variable costs are 65%, 65% of the sales, and the fixed cost amount to 32 lakhs per annum, excluding interest but including depreciation of 7.5 lakh. Variable costs are 65%, meaning 65% on 120, 78 lakh. Fixed cost amount to 32 lakh per annum, right? Excluding interest. Fixed cost, remember, this cost is fixed operating cost. It does not include interest component. It always includes the depreciation component because depreciation is always an operating expenditure, non-cash, but operating expenditure. So 7.5 lakh depreciation is already included in the fixed cost. Ashwin Limited has a total capital employed of 100 lakhs, consisting of equity share capital, shares of rupees 100 each, 60 lakhs, and 10% debentures of rupees 40 lakhs. Equity share capital 60 lakhs and 10% debentures 40 lakhs. The company's tax rate is 40%. Ashwin Limited would like to know the impact of 30% increase and 10% decrease in sales on its EBIT and EPS. Sales drops by 10%. Sales increases by 30%. What is the impact on EBIT and EPS? Compute the revised EBIT and EPS using the concept of leverage. For understanding the concept, what we will do is, we will consider the 30% increase by preparing a profit and loss statement. We will consider the 30% increase by preparing a profit and loss statement. For the 10% decrease, having learned the concept of leverage, for the 10% decrease, we will use the leverage formula and thereafter get the result. So we will understand in that pattern, 30% increase is understood by preparing P&L statement, and from that we will learn what is the concept of leverage. So let's have a look at the solution. The slide before you comprises the entire solution. I would like to take you, I will take you through step-by-step basis. I would like you to observe the slide from that perspective on a step-by-step basis and avoid looking at all the other linkages and all that. First, we will concentrate on the present situation. Sales, as indicated earlier, 10,000 units, 100 rupees, 12 months, 120 lakh. On that 65% variable cost, 78 lakh. Sales minus variable cost is equivalent to contribution, 42 lakh. Fixed cost includes depreciation also. So consequently, we calculate EBIT, earnings before interest and tax, equal to 10 lakh. Now, going back to the question, the capital is equivalent to 60 lakhs of equity and 40 lakhs of debt. So on that debt, 10 percentage interest. So 10 percentage on 40 lakhs is equivalent to 4 lakh. All this information, my dear friends, are in rupees lakhs. Now EBT is also in rupees lakhs, 6 lakh rupees. Tax is equivalent to 40%. Tax rate is equivalent to 40%. So 40% on 6 lakh, 2.4. Earnings after tax in rupees lakhs, 3 lakh 60,000. Now the number of equity shares, let's again go back to the question to confirm this. Number of equity shares equivalent to 60 lakhs divided by 100 rupees. 60 lakhs divided by 100 rupees. So the number of equity shares is equivalent to 60,000 shares. So earnings per share, since there is no preference dividend, this EAT itself is equivalent to residual earning. EAT itself is equivalent to residual earning available for equity shareholders. 3,60,000 divided by 60,000. This number is in rupees, 6 rupees per share. Up to EAT in this statement, it is in rupees lakhs. EPS is the normal amount in rupees. Now this is the present situation. Now let's look at the effect of 30% increase. 30% increase in sales, 120 plus another 30 percentage, 156. Variable cost will also increase by another 30 percentage, 101.4. Instead of calculating 78 plus 30 percentage, you can also calculate 156 multiplied by 65 percentage. I repeat, 156 multiplied by 65 percentage, you will get the same number, variable cost. Contribution is calculated as sales minus variable cost. Fixed cost remains the same, that is the starting point for our advantage. Fixed cost remains the same, so that number is equivalent to EB 32 lakh. So the balance is equivalent to EBT. Balance is equivalent to EBT. In our exam, in our calculation, EBT is equivalent to 22.6. Interest component also remains the same, 4 lakh rupee, and therefore EBT is 18.6. Tax is paid at 40% now on a higher income. So 18.6 into 40%, 7.44. So balance earning after tax is equal to 11.16 lakhs. If you divide this by 60,000 shares, the earnings per share from 6 rupees, it will shoot up to 18 rupees and 60 paise. Now, there is a 30% increase in sales. Now, how do we get this 30%? One, it is given in the question. Alternatively, if you have the present turnover and the proposed turnover, 120 is the present turnover, 156 is the proposed turnover, the percentage increase can be calculated as the difference between these two numbers, 156 versus 120, divided by the base number. I repeat, difference divided by the base number. So that's the calculation for the turnover in terms of percentage increase in turnover. 156 minus 120 divided by 120, 30%. Now let's turn our attention to the next item, namely EBIT. Look at the items that I am marking in terms of bold on the left hand side, and those corresponding items which are marked in blue color in the profit statement. EBIT, the revised amount is 22.6, old amount is 10. So the percentage increase 22.6 minus 10 divided by base number 10, 126%. I repeat, it is equivalent to 126%. This is the impact on EBIT. We'll now turn our attention to the last item, namely EPS. 6 rupees shoots up to 18.6. A difference of 12.6 when compared to the base number 6, it is equal to 210%. Now observe the three percentages carefully. 30% sales increase has not led to only 30% increase in EBIT. It is magnified, it is glorified to 126 percentage. Similarly, 126 percentage increase in EBIT has not resulted only in proportionate increase in EPS. It is further magnified, further glorified to 210 percentage. So, a small extra effort by the salesman to achieve 30% more sales makes the shareholders' EPS increase by 210 percentage magnification effect. This advantage created to the shareholder is on account of two factors. One, the fixed cost remaining constant, we call that as the operating leverage. The interest component remaining constant, we call it as the financial leverage. Now, fixed cost remaining constant is called operating leverage. So, we have a formula for operating leverage. It is called degree of operating leverage, the computation, degree of operating leverage. Very easy to remember the formula. Operating leverage arises due to fixed cost. So the formula is the number before fixed cost divided by the number after fixed cost. The number before fixed cost divided by the number after fixed cost. So contribution divided by EBIT. That's the formula for operating leverage. We compute the number 100 and sorry. Contribution divided by EBIT, 42 divided by 10 equal to 4.2 times. 42 divided by 10, 4.2 times. Now, what is the significance of the operating leverage? Let's understand. 30 magnified into 126. So, how can 30 become 126? That is on account of fixed cost operating leverage. So, the calculation is 4.2 times. You can take your calculator, multiply and check. 30 multiplied by 4.2 times is equal to 126 percentage. 30 multiplied by 4.2 times, magnification takes place to that extent. We call it as the degree of operating leverage. Now we turn our attention to the degree of financial leverage. Financial leverage arises due to interest cost remaining constant. So the formula will be a number before fixed cost divided by the number after fixed cost. Number before fixed cost divided by the number after fixed cost. That is the formula for the financial leverage. So EBIT divided by EBT. So when you substitute 10 divided by 6, the number is equivalent to 1.67 times. Number is equivalent to 1.67 times. Now we compute the magnification effect in this manner. 126 multiplied by 1.67 times is equal to 210. 126 multiplied by 1.67 times is equal to 210. This is the way EBIT and EPS are linked. I repeat, EBIT and EPS are linked. Now, sales and EPS, they are directly linked by using a concept called combined leverage, the combined effect of both fixed cost and the interest cost. We call it as the degree of combined leverage. So, how to calculate the combined leverage? It's a cumulative multiplication of DOL and DFO. 4.2 further magnified 1.67 times. So cumulatively 4.2 into 1.67, overall effect is equivalent to 7 times. Alternatively, contribution divided by EBT. Contribution divided by EBT, 42 divided by 6 is equivalent to 7 times. Now we can have a very direct linkage. 30 magnified 7 times is equivalent to 210. 30 magnified 7 times is equivalent to 210. As you note down the content available in this chart, I will pause for a while and I will also consider you for just quickly revising this particular idea. Sales versus EBIT, the lines sales and EBIT, these two lines are linked by the concept of operating leverage. I will repeat, sales and EBIT, these two concepts are linked by operating leverage. EBIT and EPS, these two lines are linked by financial leverage. EBIT and EPS, these two lines are linked by financial leverage. Directly, sales and EPS, these two lines are linked by the concept called combined leverage. These two concepts are linked by the combined leverage. So I will pause for a while and you can just absorb what has been discussed and note down. whatever relevant in this context. The essence of all that you have to remember is operating leverage is equivalent to contribution divided by EBIT. Financial leverage is equivalent to EBIT divided by EBT. And combined leverage is equivalent to contribution divided by EBT, or alternatively DOL to DF. Sometimes there can be questions 1 mark, 2 mark, etc., which tests your basic knowledge on this. If tax rate changes from 40% to 35%, if tax rate changes from 40% to 35%, which leverage will be affected? Operating leverage or financial leverage? If tax rate changes from 40% to 35%, which leverage will undergo a change? Operating leverage or financial leverage? Participants can send in their answer through the chat mode. You can raise your queries through that. Was that a tough question? Fine, no problem. I find some answers stating that financial leverage is affected. In fact, the correct answer will be neither. Operating leverage, financial leverage. None of these are affected. If you look at the formula in all leverages, the formula is actually before tax. We don't consider after tax at all in the calculation. Now, if you hear my question carefully, I didn't ask you whether EPS will be affected or not. EPS will be affected in case there is a change in the tax. EPS will get affected. No change in that. But my question was, which are the leverage will undergo a change? In both the leverages, the formula is always before tax. Therefore, tax rate will not have any impact on the leverage computation. Tax rate will not have any impact on the leverage computation. So it's just the before tax calculation that is important for us. Right. That's a good point that we have learned. Fine. We'll move to the next scenario. Now, question says, compute the revised EBIT and EPS using the concept of leverage. We have used the profit and loss statement format for understanding the concept. Now, we will apply the concept. Any 1% change in sales, 1% change in sales will lead to 4.2 times change in EBIT. 4.2 times change in EBIT. Therefore, if sales decreases by 10%, EBIT will decrease by 10 multiplied by 4.2 times. 10 multiplied by 4.2 times, it will come down by 42%. It will come down by 42%. So the revised EBIT in that case will be 10 lakh presently. cut 42 percentage on that. 10 lakh, cut 42 percentage, it will be equivalent to 5.8 lakh rupees, 5 lakh and 80,000 after reducing 42 percentage from the present EBIT. This is one calculation. Now, what will happen to the EPS? This is down by 42 percentage. EBIT is down by 42 percentage. Multiplied 1.67 times. 42 into 1.67. 42 into 1.67. Take calculator and compute the number. 42 multiplied by 1.67. You will get the answer as equivalent to 70 percentage. You might get 70 point something because 1.67 is a rounded off number. Therefore, 70 percentage we will take. Old EPS was equivalent to 6 rupees. Now it will be reduced by 70 percentage. Sir, why are you saying reduced? Sales reduces, therefore everything else also reduces. So 70% reduction in the EPS. So 6 rupees cut 70 percentage. So 1 rupee 80 paisa will be the new EPS. 1 rupee 80 paisa will be the new EPS. Look at the impact on the shareholder. This is what we will understand as leverage and risk. 30% increase in sales, shareholder will be very, very happy. His EPS jumps by 210 percentage. Only a small 10 percentage decrease in sales, but EPS is eroded by 70 percentage. It is eroded by 70 percentage, creating a big risk for the shareholder. We call this as the risk concept in this regard. So I'll go to the next slide, which shows these calculations. When compared to the present situation, what will be the new number? Sales decreases by 10 percentage, 120 minus 10 percentage, the revised number 108 lakh. EBIT is 10 lakh. Since there is a DOL of 4.2 times, as discussed previously, 4.2 multiplied by 10, 42 percentage reduction, and consequently, the revised EBIT, which we have discussed, is equivalent to 5.8 lakhs. EPS reduces by 70 percentage as discussed earlier. So revised EPS will be only 1 rupee and 80 paisa. You can prepare the P&L statement and check whether these numbers are correct. You can check this. Now I have a small diagram from which you can understand the linkages. Sales, EBIT and EPS. If you remember, these two numbers are linked by degree of operating leverage. These two numbers are linked by financial leverage. First line to last line directly linked by the combined leverage concept. So, if you look at the equation which is appearing here in this part, sales and EBIT. Look at the hand movement that I am showing. Sales and EBIT. A change in the number at the top multiplied by DOL times will lead to change in the number at the bottom. So this is the result calculation. Earlier number multiplied to what extent this shakes multiplied by operating leverage time, there will be a shake in the bottom number to that extent. Now EBIT versus EPS, what happens now is change in EBIT, how much time it moves multiplied by the financial leverage, that will be the impact on EPS. So first line, midline, last line. Sales, EBIT, EPS. The lower number change is equivalent to previous number change multiplied by the operating leverage times multiplied by financial leverage times respectively. A quick summary of the concepts of leverage is available in the next slide. I trust that you would have noted these points along with the discussion that we have had. This introductory question is for understanding the concept of leverage. Okay, sir. What do I have to remember in this concept, in this chapter? I need you to remember a simple table. What is that table? A summary of leverage. Some points in the table I will add at the end, but primarily whatever we have discussed, we will have a quick look at that. There are three types of leverage: operating, financial, and combined leverage. Operating leverage arises due to fixed cost. I will go column-wise. Operating leverage arises due to fixed cost. The formula for operating leverage is contribution divided by EBIT. Contribution divided by EBIT. Which lines in the P&L statement are linked by the operating leverage? Which lines are linked? The lines linked are sales and EBIT. Those two lines linkage is given by the operating leverage. So the relationship will be a percentage in change in EBIT will be equivalent to percentage change in sales multiplied by the operating leverage times percentage. This relationship is in percentage movement and not merely normal numbers. This relationship is in percentage. What should be the preferable nature? Should it be lower? Should it be higher, etc.? We will discuss that shortly. We will complete 2 more questions and then look at the preferable nature of operating leverage and financial leverage. Then financial leverage, second column. Interest cost is the reason why there is financial leverage. DFL is equivalent to EBIT divided by EBT. The 2 lines linked in this regard are EBIT and EPS. EBIT and EPS. The relationship in percentage. Any percentage change in EPS, bottom number, is equivalent to percentage change in EBIT multiplied by the DFL times. Then combined leverage on account of both fixed cost and interest. Contribution divided by EBT is equivalent to the formula for combined leverage. Alternatively, DOL multiplied by DFL. The 2 lines which are linked here are sales and EPS. So change in EPS is equivalent to change in sales, all in percentage, multiplied by the combined leverage times. So this is the summary of the leverage relationship that you have to bear in mind. 3 formula and which lines in the P&L statement are linked in this process. This is the conceptual knowledge and the memory relating to that knowledge that you need to have. We will now take another question relating to computation of numbers based on this leverage concept. I would like you to look at this question. Complete the following statement from the given data. Profit after tax is equivalent to 5% on sales. Profit after tax, 5% on sales. Income tax rate is equivalent to 50%. Income tax rate is equivalent to 50%. Degree of operating leverage, 4 times. Debt component in capital, nil, no debt. Variable cost is equivalent to 3 lakh. This is the information. The statement is also part of the question. The statement is nothing but our profit statement. Sales minus variable cost is equivalent to contribution. Less fixed cost is equivalent to EBIT. Less fixed cost is equivalent to EBIT. The question does not provide interest in this statement because the earlier paragraph says debt component is nil. Therefore, interest is not there. Subtract income tax, balance is equivalent to 8. A very simple question. Now, how do we go about answering this question? Very simple. In our answer, we will have a 2-column table. You can also note those who have joined us live and are working out the problems parallelly. You can note them in 2 columns. First column particulars, second column amount, second column percentage, or you have 3 columns, that will be better. Particulars, percentage, and amount. Particulars, percentage, and amount. So let's write the information. Sales minus variable cost. Sales minus variable cost is equivalent to contribution. Subtract fixed cost is equivalent to EBIT. Just for writing the format properly, just for that purpose, less interest is equivalent to EBT. Less interest is equivalent to EBT. Less tax is equivalent to EAT. Less tax is equivalent to EAT. This is the information. Now what we will do, we will first fill up the percentage column. Refer to question, first point. Profit after tax, 5% on sales. So in the percentage column, profit PAT is equivalent to 5%. So sales is equivalent to 100%. So first line 100, last line 5. This is the first calculation. Next, income tax rate is equivalent to 50%. This is a very direct information. After paying 50% income tax, profit after tax is equivalent to 5% on sales. So the balance 50% is equivalent to 5%. So tax is also equivalent to 5% on sales. Tax is also equivalent to 5% on sales. So working backward, we will get EBT. EBT is equivalent to 10%. Working backward, 10%. Interest is nil. Therefore, consequently, EBIT is also equivalent to 10%. EBIT is also equivalent to 10%. Now, we will apply the formula for degree of operating leverage. For the degree of operating leverage. What is the formula? We can write below the statement. Contribution divided by EBIT is equivalent to contribution divided by EBIT is equivalent to 4 times. Now, as per the table, if you glance at the table, you find that EBIT is equivalent to 10 percentage. EBIT is equivalent to 10 percentage. So contribution divided by 10 percentage is equivalent to 4 times. Contribution divided by 10 percentage is equivalent to 4 times. Therefore, cross multiplication, contribution is equivalent to 40 percentage. Contribution is equivalent to 40 percentage. We put that number in the table. Contribution is equivalent to 40 percentage. Now, we can compare sales and the contribution and get variable cost as the balancing figure. Variable cost is equivalent to 60%. You can compare contribution and EBIT and get fixed cost as the balancing figure, which is equivalent to 30%. Now, the entire percentage column is completed. We have only one more number in the question. What is that one more number? Variable cost is equivalent to 3 lakhs. So we will write in the amount column, variable cost is equivalent to 3 lakh. And you just now know that the variable cost is equivalent to 60%. So if variable cost 60% is equivalent to 3 lakh, if variable cost 60% is equivalent to 3 lakh, proportionately, what should be the other numbers? You can calculate all the other numbers and state them. You can compute all the other numbers and state them accordingly. Please go ahead, complete the calculation. So what do you get as the sales amount in this case? You can bring out your answer. As very nicely being pointed out by students here, the sales amount is equivalent to 5 lakh. Correct. And proportionately, all other numbers can also be calculated. Your statement will be like this. This is a very direct question involving the application of the formula pertaining to operating leverage. There have been 2 or 3 main examination questions like this involving 2 companies. This is for one company. Like the data given for one more company. So this is the operating leverage, this is the financial leverage. Like you have to link up numbers and prepare the profit and loss statement. So this is in relation to this question. I think the computation must have been completed at your end. We will now move to a third question. We will learn some more concepts in this connection. A firm has a capital employed of 12 lakh rupees. A firm has a capital employed of 12 lakh rupees with a debt equity ratio of 2:2. 12 lakh is the capital employed. Let me understand this. 12 lakh is the capital employed. Debt equity ratio of 2:1. So debt is 8 lakh and equity is equivalent to 4 lakh. I make this calculation. Debt is 8 lakh and equity is equivalent to 4 lakh. Its DFL is 1.67 times. Degree of financial leverage 1.67 times. Fine. If interest on debt is 1,20,000, interest on debt is 1,20,000. Find out. First, interest rate on debt. That's very simple. Just now we have talked about loan amount as being equivalent to debt amount as equivalent to 8 lakh rupees. 1,20,000 is the interest paid on 8 lakh rupees. 1,20,000 is the interest paid on 8 lakh rupees. So what is the interest rate? We do not need any other calculation to get this number. 1,20,000 divided by 8 lakh. That will be the computation pertaining to interest rate. So what will be the interest rate in this case? Yeah, as responded by students here, the percentage is equivalent to 15%. Percentage is equivalent to 15% interest rate. Second question, PAT, profit after tax, if tax rate is equivalent to 40%. We will make some calculations on this. Third one, EPS, if face value per share is equivalent to 10 rupees. Okay, 4 lakh is the total equity capital. Now, face value per share is 10, which means 40,000 shares. Fine. ROI is equivalent to return on investment, also referred to as return on capital employed. Both are same. Return on investment, ROI, is equivalent to return on capital employed, ROCE. Both are same. The next one, whether the company is favorably leveraged. Oh, whether the company is favorably leveraged. We'll make some calculations and understand all this. So let's look at the procedure involved. I have the slide showing the computation. I will explain, then you can work on. Capital employed, as discussed initially, 12 lakh, comprising debt and equity, 2:1, 8 lakh and 4 lakh. It's a very straight calculation. Now, I prepare the profit statement for computing PAT and for computing EPS. Now, in terms of percentage and amount, I will indicate the values and then I will fill up whatever numbers are available. The question says tax rate is equivalent to 40%. So, tax is 40, EBT is equivalent to 100%, EAT is equivalent to 60%. Now, I apply the formula after writing these three numbers, EBT, tax and EAT. I apply the formula for DFL. EBIT divided by EBT. EBT already calculated as equivalent to 100. So cross multiplication, I have DBIT is equivalent to 167%. Using the formula for financial leverage, cross multiplication, DFL formula 1.67 times. So cross multiplication, EBIT is equivalent to 167%. So interest is now computed as a balancing figure. 167 versus 100, balancing figure 67%. And if that 67% is equivalent to 1,20,000, proportionately what are the other numbers? 67% is equivalent to 1,20,000. Proportionately what are the other numbers? I round them off to the nearest rupee. I round them off to the nearest rupee. In this case, 299,104 is the EBIT. 179,104 is the EBT. 40% on that, and therefore EAT is equivalent to 107,462. I also make one more calculation. Number of equity shares, 4 lakh divided by 10 rupees, 40,000 shares. Now, after doing all this calculation, I proceed to write the answers. As discussed earlier and correctly pointed out by many of you, interest rate is equivalent to 15%. This is the computation. Second question says, write what is the EAT. I have to just copy the number. I have put a question mark here. You are well aware. This is the EAT, 107,462. So when you present the answer in the professional examination, please ensure that you write the number properly. Then third item, EPS. EPS, you will have to show the formula. What is the formula? I have written only the substitution of numbers. What is the formula? You should write the formula properly. It is not EAT divided by number of equity shares. It is actually residual earnings divided by number of equity shares. I repeat, residual earnings divided by number of equity shares. In this question, preference dividend is not there. So EAT itself is equivalent to residual earning. You should not change the formula. You should write the formula as it is. Residual earning divided by number of equity shares. The number is equivalent to 2.69. This is in rupees. Then comes return on capital employed. Return on capital employed, also referred to as return on investment. What is the formula for this? EBIT divided by capital employed. I will repeat, EBIT divided by capital employed. This is the formula for ROC. So you have to again write the formula, substitute and get the result. Here it is equivalent to 24.93%. Now, you had one more question, you remember, whether the company is favorably leveraged. Now, what is the answer to it? The answer comes out of common sense question. The common sense approach is, can a company borrow? The answer, common sense answer to this is, it can borrow if it is earning at a rate higher than what it is paying as interest on debt. If it is earning at a rate with borrowed funds, we invest in our business and generate return, we should be rotating and generating a rate higher than what we are going to pay. We are earning at the rate of 24.93, say almost 25%. We are paying interest at the rate of 15%. Is it a good sign or a bad sign? Very much good sign, which means we are favorably leveraged. We are favorably leveraged. So when is a firm said to be favorably leveraged? When return on capital employed greater than the interest rate on debt. Return on capital employed greater than the interest rate on debt. So I will pause for a while you assimilate all this information in your mind as you absorb all this information. After that, we will go into the nature of DOL, how DOL should be, the lower or the higher, etc. We will go to that shortly. Please make a note of this points. In this question, we have learned how to apply the formula for financial leverage. We have also learned the formula for return on capital employed, formula for EPS, and we have also learned that this company is favorably leveraged because return on capital employed is greater than the interest rate on debt. These are all the learning points in this question. Right now, we will learn some more concepts in this chapter before we close this chapter. What is the concept that we are referring to now? Nature of DOL. What should be the nature of DOL? Consider two companies' profit and loss account like this. A and B, both companies have the same sales, same variable cost and same contribution. The first company has a fixed cost of 30,000. Second company has a fixed cost of 50,000. So correspondingly, there is a profit change. First company earns more. Now, if you ask a question, which company is preferable? Our answer will be based on more profit earned in the first company. Therefore, company A is preferable. More profit is earned. Very simple logic. Now, let's look at the concept of operating leverage. Contribution divided by EBIT. 80,000 divided by 50,000. 80,000 divided by 50,000. The number is equivalent to 1.67 times. And in the second case, it is equivalent to 2.67 times. Second case is equivalent to 2.67 times. Since company A is preferable, we understand If operating leverage is low, it is better. Operating leverage is low, it is always better. Break-even point, which we study in marginal costing, represents a no profit, no loss situation. The lower the break-even point, the better it is. Lower the break-even point, the better it is. So consequently, we look at the amount of break-even point in both the companies, 75,000 and 1,25,000. So correspondingly, we prefer a low break-even point. Company A is preferred. So moral of the story, low DOL will represent low fixed cost and low break-even point. High profit, therefore always low DOL is preferred. Always low DOL is preferred. This is the concept. There has been a query from one of our students here on the concept of favorably leveraged and all that. EAT is only 1 lakh and all, but interest is coming up to 1,20,000. How can you say it is favorable? My dear friend, that EAT of 1 lakh is after already paying 1,20,000 as interest. After already paying 1,20,000 as interest. Now, by the end of today's session, not just now, we will carry it forward. This learning we will carry it forward to subsequent chapters also. We are not looking at amount of profit. We are looking at profitability. Profitability, the rate of earning profit. If we earn at 25 percentage roughly, we are paying only 10 percentage, 12 percentage interest on debt. We will be able to, or 12 or 15 percentage interest on debt in this case. We are in a favorable position and not otherwise. Either way, we don't look at the amount, we look at only the rate, which is more important for our decision. Total amount of profit is not important. In fact, the profit that you are trying to state is after paying the interest component, and therefore it is not appropriate to compare these two numbers. In this case, the company is favorably leveraged. Now, let's move to the next area. I trust that you would have understood this particular point. This is the point that I am referring to, the one which is shown in shaded portion in your table. Now, the one which is pointed out to you, the low DOL is preferable. Low DOL is always preferable. This is the first concept. Now, as regards DFL, just recall the discussion that we have just now had in relation to the earlier question. There can be three situations as to what type of return we are earning. One situation, our return on capital employed is greater than the interest rate. We earn at a higher rate. Please note, it is not the amount, it is the rate. In that case, is it preferable to borrow? Is it preferable to borrow? Answer, yes, it is preferable to borrow. Preferable method of funding or financing will be debt. So what should be the preferable nature of DFL? It is better to go in for a high DFL. Borrow more and have a high DFL. Borrow more and have a high DFL. If ROC is equivalent to interest rate, whether you borrow or not, it doesn't matter because EPS will not be impacted at all. EPS will not be impacted at all. So either debt or equity, whatever be the source of fund, you can take any one of these. If ROC is less than the interest rate, you are not even able to earn the rate that you are going to pay as interest, then you should not go for borrowing. Preferable method of funding should be equity. In that case, low DFL is preferable. So, moral of the story, higher DFL is preferable only when ROC is greater than the interest rate. I will repeat, higher DFL is preferable only when ROC is greater than the interest rate. So DOL individually should be lower. DFL individually is preferable to be higher when ROCE greater than the interest rate. Very good. Then what about the combined leverage? Next question. In that case, we opt for this best combination. Low DOL and high DFL. Very simple logic. Low DOL will mean low fixed cost and therefore low break-even point. Low fixed cost will mean high profit. Low fixed cost will mean high profit, EBIT. If profit is high, remember the formula for ROCE, EBIT divided by capital employed. EBIT divided by capital employed. EBIT, numerator is high, therefore the percentage will also be high. Numerator is high, percentage will also be high. So ROCE is higher. If ROCE is higher, greater than the interest rate, then you should go for more debt you should have high DFL, and therefore the combination of low DOL together with high DFL. Combination of low DOL together with high DFL. This is the appropriate combination for leverage. The essence of this entire discussion is based on one simple point. I am an entrepreneur. I borrow from a bank at the rate of, say, 12% interest. At the rate of 12% interest. I need that money for investing in a project which generates 25% return. Which generates 25% return. Can I borrow from the bank in this case? The answer is yes. Because we are earning at 25, we are affordable to pay that 12% interest to the bank. So we can borrow. Suppose the project generates, the investment generates only 8% return. I am not affordable or I cannot earn adequately even to pay the bank interest. So consequently, in that case, I should not borrow. That is the third situation here, ROCE less than the interest rate. When ROCE is equivalent to interest rate, I am not bothered about whether I am using my own money or bank's money. Either way, no impact on me, no great surplus is generated. So consequently, whatever I earn, that will be useful only for making the payment to the bank interest, and consequently, there is no great surplus generated for me. This idea, this common sense approach is what is given in very nice arrangement of words, nice combination of words, etc. Leverage, operating leverage, financial leverage, combined leverage, etc. It all boils down to one common sense question. Can a firm borrow? The answer is yes. Only if ROCE greater than the interest rate. Can a firm borrow? Question. Answer yes. Only if ROCE greater than the interest rate. In that case, you are called as favorably financially leveraged company. You are called as a favorably financially leveraged company. So this is the concept of leverage, my dear friends. So please go through all this discussion that we have had in relation to leverage so that you will gain control over the procedure involved. You will be able to understand the calculations that we have made. So revise them properly so that you can understand the various concepts in this connection. The balance part of today's discussion will be spent on the next chapter called cost of capital and the capital structure. The balance part of today's discussion will be on the next chapter called cost of capital and the capital structure. That was the right. Thank you. So cost of capital and the capital structure is now related to you. Fine. Now, what is this cost of capital? What is this idea? What are we talking about? What do you want us to know in this chapter? My dear friends, this is one of the very simple concepts. Let me just consider a simple example or simple explanation prior to opening up this topic. A company makes sales. Yesterday we have talked about working capital management. It rotates. It rotates all its working capital items. It generates surplus in every rotation. That surplus is popularly called EBIT, operating profit, EBIT. The company opens its distribution counter and finds a queue before it. How many people are there in the queue? 4 people are there. Who are these 4 people? The first person in the queue is the debenture holder, the person who has lent. Any long-term lender, debt is what is covered here. Any long-term lender, we will represent him by this word, debenture holder. Who is the next person standing in the queue? Government, tax. Who is the third person standing in the queue? Preference shareholder. Who is the fourth person standing in the queue? Equity shareholder. So the queue order is maintained always. These people don't interchange their position. First debenture holder, then government, then preference shareholder, then equity shareholder. 4 people. Now, the first person standing in the queue waits for less time and therefore less risk and therefore less return expectation. The lower the waiting time, the lower the risk. The higher the waiting time, the higher the risk. So time and risk go together. Risk and return also go together. The lower the risk, the lower the return expectation. Higher the risk, higher the return expectation. So, debenture holders expect, say for example, 12% debenture interest. After paying debenture holders, we have government taxes paid. Then comes preference shareholder, the next investor. The next investor, debenture holder. Incidentally, investor means any person who has provided or who will provide long-term funds to the company. Who will provide long-term funds to the company. Investor equal to equity shareholder? Yes. Investor equal to preference shareholder? Yes. Investor is equivalent to a bank which has given a long-term loan to the company? Yes. Which of these is investor? All the three are investors. All the three. Any person who provides long-term funds to the company is called as an investor. Any person who provides long-term funds to the company is called as an investor. So all these three people represent investor. So debenture holders, 12% interest is paid. After paying government, the next investor is the preference shareholder. His waiting time is longer. No? He is waiting for the debenture holder to be satisfied, then government to be satisfied. His turn at the counter comes next. Yes, now I'm at the counter. I will not expect 12%. I will expect more than 12%. Say 15%. 15%. Because waiting time is long. Now, after preference holder is satisfied, now we have the equity shareholder who comes, the last person in the queue now comes to the counter. He tells the company, look, I have waited for everybody else to get satisfied. My waiting time is higher. I am undertaking the maximum risk. I am undertaking the maximum risk. Therefore, I expect a very high return. So higher the risk, higher the return expectation. So consequently, we have to pay dividend of say 24%, 30%, etc. to keep the equity shareholder happy because he has waited for that long before the other people are satisfied. So the debt represents the cheapest source of finance for the company, and equity represents the costliest source of finance for the company. Debt represents the cheapest source, and equity represents the costliest source. When we consider cost of capital, what is the concept of cost of capital? Every year, the company has to pay some interest or some preference dividend, some equity dividend in order to keep the shareholders, investors, etc. in good spirits. The payment is an outflow from the company's viewpoint, outflow towards capital, payment towards capital, therefore called cost of capital. Therefore called cost of capital. So we'll be looking at what are all the concepts of cost of capital. A overview of this chapter, what we are going to learn in this chapter is given to you in the form of a small diagram. First, we are going to learn about various components of capital and their cost. In debt, we have two formulas. Cost of debt denoted by K, subscript to B. Cost of preference share capital written as KB, we have two formulas. In cost of equity, we are going to consider 6 formulas. Cost of retained earnings, we have a formula. And overall cost of capital, KO, overall cost of capital, weighted average cost of capital, we are going to have a formula. We are going to learn a formula. So how to compute all this cost of capital? The second part of this chapter, we are going to learn EPS related concepts. EPS related concepts, what is that? One is how to maximize EPS. We call this concept as trading on equity. We have one illustration under each of these. I would request you to show patience and observe what is being discussed today so that you will be able to understand this concept very effectively and handle any type of question, both theory as well as calculation. First is how to maximize EPS. We call this concept as trading on equity. Second concept, how to have equal EPS of two different funding options. We call it as the EBIT-EPS indifference point. I am making it very clear. It is not a minus sign, it is hyphen. It is not merely indifference point because we have a concept like this in marginal costing. Therefore, you would call this as EBIT-EPS indifference point. Third is a situation where there is no EPS, zero EPS. This is called financial break-even point, not just a break-even point. Just a break-even point is no profit, no loss. Here, company is earning profit, but remember the cue, debenture holder is paid, government is paid, preference shareholder is paid. When it comes to the equity shareholder, company says nothing available. So no EPS. We call this level as the financial break-even point. Three concepts. And then we have some capital structure theories, two objectives, nine assumptions, and the four theories. The four theories are classified into theories which say weighted average cost of capital. Weighted average cost of capital is nothing but equal to overall cost of capital. This is not a constant number. The other set of theories says weighted average cost of capital is a constant number. Two theories called net income approach and traditional approach fall under this category. Two theories called net operating income approach and M&M approach, Modigliani and Miller approach, fall in this category. This is the overall structure of the topic that we are going to discuss now. We will now turn our attention to the concept called cost of debt. How to compute the cost of debt. We will have two formula in this regard. We will take that slide and proceed forward. How to calculate the cost of debt. Debt can be classified into two categories, irredeemable and redeemable. What is meant by irredeemable here in this context? It is repayable only upon winding up of the company. Only upon winding up of the company. Redeemable is what is repayable in the normal course of business. Repayable in the normal course of business. So computation of cost of debt runs in this way. Interest into 100% minus tax rate divided by net proceeds of issue. Now, what is this? Why are you calculating interest into 100% minus tax rate? The idea is very elementary. Interest is a cost which is debited in the P&L account for computing the taxable profit. So, if you pay interest, your taxable profit will get reduced and therefore you will end up paying less tax. So, if interest is paid, tax is saved. If interest is paid, tax is saved. Therefore, the net effect of this is calculated as available in this illustration. Two companies A and B have the same EBIT. Second company only pays interest, and instead of paying 175 tax like the first company, it is paying only 70 as tax. So the EAT difference 325 versus 130. The difference in EAT is 195. It is not just 300 rupees. 300 rupees is the extra expenditure of the second company. But the profit difference is not 300 rupees. Profit difference is only 195 because out of 300, we have saved tax and therefore net effect is equivalent to interest into 100% minus tax rate. This debt is the formula for cost of debt in case it is irredeemable. In case the debt is redeemable, we have different components of payment. One is the interest component, the other one is the extra payment on redemption. I will repeat, extra payment on redemption. Suppose 100 rupees is the face value. Redemption is at 125 after 5 years. Redemption is at 125 after 5 years. The extra payment has to be made over and above the interest that we pay every year. Extra payment has to be paid over and above the interest paid every year. So, what is the extra payment towards capital or excess capital we are repaying? 125 minus 100, 25 rupees. That is a payment that relates to a 5-year time frame because of the redemption period being 5 years. So, on an average, per year, additional cost for the company is equivalent to 125 minus 100 divided by 5 years equivalent to 5. Like this, we calculate the premium on redemption on an average basis, which is referred to as RV minus NP divided by N, which is referred to as RV minus NP divided by N, redemption value minus net proceeds divided by number of years. In the denominator, we take the average liability RV plus NP divided by 2, redemption value plus net proceeds divided by 2. This is the calculation for the redeemable debt. So, two types of calculation, debt being irredeemable and debt being redeemable. This is the formula. I will pause for a while you will absorb this information. Try to register the formula in your mind, and then we will move into the formula for preference share capital, cost of preference share capital. Right then, my dear friends, we will now move on to the cost of preference share capital, which is computed on similar lines. Preference share capital is also classified into irredeemable and redeemable. Wait. I am able to sense that many of you are aware that under the company law provisions, this concept of irredeemable preference share capital is not applicable. Correct. But we take it only for argument's sake. Had it been irredeemable, what would be the computation? So only on theoretical basis and not on practical basis. We consider only to that extent. So irredeemable means redeemable or repayable only on winding up. In that case, the formula is preference dividend divided by net proceeds of issue. Please note, for cost of debt, you would have taken interest. Here it is preference dividend. There we would have taken 100 minus tax rate. Here we don't have any such concept. This is a post-tax payment, therefore not deductible for tax purposes. So direct calculation. Preference dividend divided by net proceeds of issue. In case of redeemable debt, that is redeemable in the normal course of business, the formula will be preference dividend plus redemption premium, average premium on redemption, RV minus NP divided by N, divided by average liability, RV plus NP divided by 2. Please do calculate, please do note down this formula, please do practice. Two are the illustrations relating to application of the formula, directly how to apply this and express it in percentage. Cost of debt is expressed in percentage, cost of preference share capital is expressed in percentage, but all cost of equity, everything, all the costs are expressed in percentage. Now, certain points you have to bear in mind. These are all very basics of finance. Dividend percentage versus dividend yield percentage. Suppose we are informed that a company pays 40% dividend. The company pays 40% dividend. 40% dividend on its face value, say 100 rupees. So amount of dividend is equivalent to 40 rupees. This is called a dividend rate. I repeat, dividend rate. Dividend per share divided by face value per share, dividend rate. Now, we have another concept called dividend yield. I am not holding any share in this company. I want to purchase the share of a company from the market. I want to purchase the share of the company from the market. Today, the market price of that company's share is equivalent to 2000 rupees. Market price of the company's share is equivalent to 2000 rupees. I buy one share of that company and I expect 40% dividend. The company will pay 40%, but not on the market price, but on the face value. So 100 rupees is the face value. So I get only 40 rupees dividend, but my investment in that one share is equivalent to 2000 rupees. Investment in that one share is equivalent to 2000 rupees. This calculation, 40 divided by 2000. 40 divided by 2000, this is called dividend yield. This is called dividend yield. And what is the dividend yield in this case? 40 divided by 2000. How much am I getting? 40 rupees on an investment of 2000 rupees, today's market price. If I am a new shareholder who wants to purchase the company's share, what is the calculation? What is the number? 40 divided by 2000. I get only I get only 2%, right? 40 divided by 2000. I get only 2%. Is it a worthy investment for me? My dividend yield is 2%. No. My bank savings bank account might generate 2.5 or even 2.7 percentage interest. So consequently, this is not a worthy investment. Consequently, it is not a worthy investment. Right. So this is the nature of dividend rate versus dividend yield. As a student of finance, we should try to learn the subtle variations and not misuse one word for the other. Dividend rate is different, dividend yield is different. Both are in percentage. Now, a query has been raised here that why do we take the average of the two numbers RV and NP in the denominator? Why do we take the average of these two numbers? Well, the idea is very simple. For both redeemable debt as well as redeemable preference share capital, the denominator represents average liability, opening plus closing divided by 2. At the beginning of the period, in your balance sheet or in your funds statement, I'm not looking at the balance sheet as such, the fund statement, the obligation is what we have collected, net profits. At the end of the period, the obligation, when you redeem, the obligation, end of the period, the obligation is what you have got to redeem, the value what you have got to redeem. So, opening liability plus closing liability divided by 2 is equal to average liability. Opening liability plus closing liability divided by 2 is equivalent to average liability. Now, why are we not taking that in the first part, in the irredeemable debt? That's the next question. Logical question. Now, this is repayable only upon winding up. So, my business I have to evaluate only till it is wound up. Therefore, at the time of winding up versus at the beginning, at any point of time, therefore, at all points of time, the amount of liability is equivalent to net proceeds. The amount of liability, the amount of funds is equivalent to net proceeds. So, we don't take average liability very specifically in the first case because always there is going to be the liability at all points of time. This is the explanation for the query that has been raised. Now we will move on to the king of all cost, namely cost of equity. There are only 6 approaches to computation of cost of equity. Now, what are the 6 approaches? The 6 approaches are written top down. The name of these approaches are written in this slide. So, first approach is dividend hyphen price. There is no minus sign here. Dividend hyphen price approach. The second approach is earnings hyphen price approach. The third one is dividend price plus growth. Dividend price plus growth approach. The fourth one is earnings price plus growth approach. Fifth one is realized yield approach. And the sixth one is called capital asset pricing model approach. CAPM. I repeat, capital asset pricing model approach. Now, what is the formula under dividend price approach? Very simple. Next year's dividend divided by today's market price. I will repeat. Next year's dividend expected divided by today's market price. That is the shareholders' expectation. Why do we take next year's dividend? Very simple. Now, time 0 is equivalent to 1st April of a financial period. Time 0 is equivalent to 1st April of a financial period. If you invest money in a company on 1st April of a financial period, morning, immediately evening you can't go and ask them, come on, give me dividend. The company says, wait, let me use your funds, rotate, generate surplus. Let me prepare, assume this is 1st April of 2020. I repeat, 1st April of 2020. We will work for 1 year, prepare profit statement for the year ended 31st March 2021, compute the profit and then declare dividend out of that. So I have to wait for 1 year for dividend declaration. So next year's expected dividend divided by today's market price. Under this approach, the shareholders are expected to concentrate only on whether the company is distributing profit or not. Are we getting dividend? That is the shareholders' expectation. That is the shareholders' expectation. First approach. Second one represents a more mature approach of the shareholder. In the sense, I don't bother whether the company is distributing the profit or not, whether it is declaring dividend or not. Is it earning profit? Yes. It may distribute, it may not distribute, that does not affect me. I will be happy if in certain situations the company is not distributing. For example, the company is able to rotate and generate 40% return on its business. It distributes that money to me and I put in some other bank deposit or other where I get around 5.5%. I will not be happy if the company gives me the money. I'll be happy if the company holds that money, rotates it, and generates a surplus so that the value of my share increases. So, a shareholder now becomes a very knowledgeable person. First shareholder is interested in the dividend under the first approach. Now, a more mature approach of the shareholder is interested in EPS, that is profits of the company. Whether it is distributed or not, it doesn't matter. Second approach. Third approach, the shareholders' expectation is only dividend now, but dividend not for just 1 year, but on a permanent basis till infinity. Till infinity. Going concern assumption, no? So consequently, till infinity. So here, the shareholders' expectation is in growth in earnings and dividends. Sir, you are talking about dividend price plus growth approach. Why are you putting growth in earnings and dividends? Shouldn't it only be growth and dividend? Growth in dividend. Let's understand a very simple point, my dear friends. Without earnings increase, dividend cannot increase. You cannot pay dividend out of nowhere. Your earnings have to increase. Only then dividends can increase. So the shareholder will sincerely pray that the company should have more earnings and also distribute more dividends. So that is what is considered under the third approach. The fourth approach, shareholder is interested only in the EPS, growth in EPS. Let us keep on learning more and more. Fifth one, realized yield approach. The shareholder tries to see whether we can sell the share at the end of the year, or at least find out what would I have got had I sold the share. If I hold the share for a year, I will expect dividend, and when I sell the share, I expect an increase in the share price. Today the share price is equivalent to Today, the share price is equivalent to 300 rupees. Next year, the share price is expected to be 360. I will be able to earn, if I sell the share, I will be able to earn some amount of rupees 60 as a surplus in this case. So, the shareholder will be interested in earning all that in addition to dividend. So, in this case, dividend of the next year plus increase in the share price divided by today's market price. Please observe that in all the five formula, first to fifth, in all the five formula, the denominator is equivalent to today's market price. In all the five formula, the denominator is equivalent to today's market price. The sixth formula, called the capital asset pricing model, is a very logical and easy to understand formula. I have some money. A friend tells me, come on, let's invest in the share market. I tell him, I'll come along with you to the share market. I have already got this money in my bank where I am earning 5.5% interest. 5.5% on fixed deposit I'm getting. So if I come to the share market, I am going to take more risk. Therefore, I will need much more than 5.5%. I tell my friend. The friend takes me along. Come on, you will earn, don't worry. He takes me along. I go to the capital market. I don't find one company. I find a lot of companies there. I find a lot of companies. My friend tells me, on an average, all the companies taken together, you earn 20% you can earn. All the companies taken together, on an average, 20% you can earn. That 20% is what is considered as overall market return. I repeat, 20% is considered as overall market return, RM, overall market return. And in my example, the 5.5 percentage is nothing but risk-free return. It might be bank interest rate. Sometimes question might say it is Reserve Bank of India rate. Sometimes Treasury bills rate. I repeat, Treasury bills rate, government securities rate. Any one of these words might be given in the question just to help you understand that it is risk-free return. Now, the share market gives an overall return of 20%. So if I enter the capital market, my expectation is I should get at least 20 minus 5.5, 14.5 extra. I repeat, 14.5 extra. Sir, what about the already 5.5? Yes, that is anyhow minimum I will need. 14.5 is the extra that I will need. Now I am not investing in the share capital market as such. I identify one company, say company A, company B, company X, like that I invest in one company. Now all the companies don't do the same business. Different companies do different business. The type of business that they do, the type of incomes that they have leads to a risk. For example, foreign exchange rate movement risk. Foreign exchange rate movement risk affects information technology sector companies if they have foreign clientele. It affects oil sector companies because primarily when we consider the change in oil prices globally, it affects those companies. It may not affect a company which is operating purely on local producers, local products which have no direct connect with the foreign exchange rate. So, depending upon the type of business, each company has a different risk, and I attach a risk factor. I, the investor, attach a risk factor to each company. Some companies may have less risk, say zero point 0.8. That risk factor is referred to as beta. Risk factor is referred to as beta. Now, some companies may have high risk, 1.5, like that. So, beta times, I am expecting more. No? From a risky company, I will expect more. My premium will be higher. Therefore, beta times the excess, 14.5% on the taken. Very simple logic. I will expect at least time value of money, in this case 5.5%, plus premium for bearing the additional risk. This concept is what is called capital asset pricing model approach. Cost of equity is equivalent to RF risk-free return plus beta times RM minus RF. Let us remember the terminology very carefully. These words have to be remembered very carefully. RM represents overall market return. RM represents overall market return in the capital market. RF represents risk-free rate. Beta represents risk factor of a particular company. Risk factor of a particular company. RM minus RF is called market risk premium. RM minus RF is called market risk premium. Sometimes the question may say market risk premium is equivalent to 11%. Market risk premium is equivalent to 11%. Please observe, if the word is market risk premium, it is not RM, it is RM minus RF. That is only equivalent to market risk premium. So directly multiply that by beta times and then add the risk-free return, you get the cost of equity. So please note the difference between overall market return RM and market risk premium, that is the excess over the risk-free return. These are the concepts. I will also add one more point here. Yesterday, towards the closure, I had asked you to go through the formula pertaining to various ratios. One of the ratios, if you remember, is price earning ratio. Price earning ratio. Very simple formula for price earning ratio. Market price divided by earnings. Price earning, right? So market price divided by earnings. Now remember the formula, market price divided by earnings, EPS. Now the earnings price approach is exact inverse of that, exact ulta of it. So EPS divided by earnings. So the relationship between EPS and the cost of equity is such that 1 divided by P ratio is equivalent to cost of equity. 1 divided by P ratio is equivalent to cost of equity. Suppose P ratio is equivalent to 5 times. P ratio is equivalent to 5 times. 1 by 5 is equivalent to 20%. Cost of equity is equivalent to 20%. So these are all the formula pertaining to cost of equity. All are very simple formula, very easy to remember. We should put in that extra effort to remember this properly, so that any particularly the meaning of terms, meaning of basic terms, etc. Once you remember them, you cannot make any unwanted mistake in the course of calculation. You will be very clear and very strong about what you are doing. We will open with a question relating to computation of cost of equity. Computation of cost of equity. I will pause for a while so that we will go through all this formula and absorb whatever we have discussed. And as has been your practice today, yesterday we did not receive many questions. Today, I am happy to note that those who have joined us in live are raising very nice and relevant questions, and also responding very nicely to the questions that I am raising. So it's a very nice concept. In spite of the relay variation, the time at which I talk, and it has to go through various processes and reach you, then you get back and come back with the answer to me. Yet, in spite of the time delay, it's really worth it, and I would wait for your questions, and please go ahead and put those questions so that you will be able to understand finance in a very simple way. After all, my dear friends, we are learning to become finance professionals. We are already literate. We have to become financially literate. So we are in the process of learning that. and gaining that knowledge. So let's work towards that effect, right? Fine. You would also have understood the difference between dividend rate and dividend yield. Don't be misled by the percentage of dividend that a company says, I am paying 40% dividend and all that. Compare it to today's market price and see whether you are getting a good return. That is called a dividend yield. So just be very clear these terms. Okay. Now we will go to a question. I would like you to go through the question and do the calculation. A very simple question to start with. Compute the cost of equity in the following situations. Interest on treasury bills is 4.5%. Overall market return is 16%. Beta factor for company X is equivalent to 0.8. Beta factor is equivalent to 0.8. One calculation. Interest on bank deposit is 6%. Overall market return is 18%. Beta factor for company Y is 1.25 times. A very direct application of the formula. I will pause for a while. You can do the calculation and tell me what is the number for company X and for company Y. The calculation is one of direct substitution. Direct substitution. For company X, KE is equivalent to RF 4.5% plus 0.8 times beta times 0.8 multiplied by 16 minus 4.5. 16 minus 4.5. This is for the first company, right? Second company, the computation will be 6% plus 1.25 times 1.25 times 18 minus 6. 1.25 times 18 minus 6. So your calculation should look something like this. The capital asset pricing model approach is applied here. The formula is shown first, followed by the substitution of the formula. You will be getting 13.70% for the first company, as very nicely responded to in the answer here. And for the second company, you will be getting 21%. Second company, we get 21%. What is the next item that we are going to learn? Before that, what have we learned so far in this topic? We have learned the formula for cost of debt. We have learned the formula for cost of preferential capital. And we have also seen the cost of equity capital. Under equity capital, we have seen it under 6 different approaches. Dividend price, earnings price, dividend price plus growth, earnings price plus growth, and realized yield approach. All these have market price of today as the denominator, followed by The sixth approach called the capital asset pricing model approach, which goes by what the investor is getting otherwise without having any risk, plus what is he expecting for the extra risk borne by him in a company. So this is the simple philosophy pertaining to capital asset pricing model. Our next area of learning is the concept of cost of capital, overall cost of capital, referred to as weighted average cost of capital. I repeat, it is called weighted average cost of capital, very popularly abbreviated as WACC. Very popularly abbreviated as WACC, weighted average cost of capital. So, weighted average cost of capital (WACC) is also nothing but equivalent to KO, overall cost of capital. Also equivalent to KO. How to compute the overall cost of capital? Very simple. Debt cost into debt's percentage in the total capital. Equities preference capital's cost multiplied by preference's weightage in the overall capital, and equity capital's cost multiplied by weightage of equity in the overall cost of capital. Those who are a little bit mathematically oriented will know that it is a very simple concept of weighted average. That is the weighted average cost of capital. Very simple. We will apply this in a question. We will learn how to compute weighted average cost of capital. We will learn how to compute the weighted average cost of capital. So WACC, I retain that. So weighted average cost of capital we will discuss in question number 2. Now, sir, what about cost of retained earnings? Another point, cost of retained earnings. Very simple. Cost of retained earnings is nothing but equivalent to cost of equity itself. Cost of retained earnings, standard assumption, it is equivalent to cost of equity itself. Because equity shareholders are only entitled to residual earnings, so it is the same number. Sometimes the company pays some dividend and after that comes back to the shareholder as rights issue for further money, etc. In that case, we may have to consider the opportunity cost for the equity shareholders. But in most cases, this assumption will work. We'll now go to question number 2. Look at the information available here. From the following information, compute WACC of Supergood Limited, WACC of the company. Assume the tax rate is equivalent to 35%. EBIT at 30% of capital employed is 3 lakhs. Let us understand the statement. See, rather than merely stock, debtors, gross profit, net profit, etc., these are all terms which are used in accounting. These are also important. You should also remember the terms relating to finance. The moment I see this 30% on capital employed is equivalent to 3 lakh. So capital employed should be equivalent to 3 lakh divided by 30%. 3 lakh divided by 30% is equivalent to 10 lakh. That's the first point. That's the understanding of the first point. Then total funds, debt to total funds, 2:5. Now observe my thought process again. First line I have read and understood capital employed is equivalent to 10 lakh. 3 lakh divided by 30%. Right? Now, capital employed, total funds, long-term funds, investment. All these 4 words represent the same number. All these four terms represent the same number. So once again, what are these 4 terms? Very simple. Capital employed, investment, total funds, long-term funds. All are same number. All are same number. So total funds is equivalent to 10 lakh. Just now calculated capital employed. Out of which debt is equivalent to 2:5. So 2 by 5 of 10 lakh. So debt is equivalent to 4 lakh. Debt is equivalent to 4 lakh. So that calculation can also be obtained by seeing the question itself. Then preference capital to equity capital. Now I understand. Debt is one portion, balance is shareholders' funds. So 6 lakh is the shareholders' funds. Debt is 4, so shareholders' funds is 6 lakh. Out of that, preference to equity 1:1, so 3 lakh and 3 lakh each. See, look at the breakup: 4 lakh, 3 lakh, 3 lakh. Now, cost of equity capital 24%, right? Fine. Preference dividend rate is 15%, very good. Interest on debenture is 20,000 for half year. 20,000 for half year. So for 1 year, 20,000 into 2, 40,000. 40,000 is the interest paid on 4 lakh of debentures. 4 lakh on debt. So interest rate is equal to 10%. Question is in the first sentence. Compute WACC, weighted average cost of capital. Observe the calculations that I am going to show in the next slide. As discussed, capital employed is equal to total funds. 3 lakh divided by 30% is equal to 10 lakh. This is the starting point. This is classified into own fund, debt, and own fund. Classified into debt and own fund. Debt is 2/5, 4 lakh. Own fund is equal to the balancing figure 6 lakh. Out of that 6 lakh, 1:1 ratio. Preference to equity capital, 1:1 ratio. So 3 lakhs each out of 6 lakhs. Now, what is the weightage of these three numbers? 40%, 30%, 30%. 4 lakh by 10 lakh, 3 lakh by 10 lakh, again another 3 lakh by 10 lakh. So 40, 30, and 30%. Now, what is the individual cost of each item? Weightage is calculated. What is the individual cost? For interest on debt, we will use the information available in the question. 20,000 is the half-yearly interest into 2. So 40,000 divided by 4 lakh worth of debt. So interest rate is 10%. Interest into 100% minus tax rate. Sir, you are not dividing by net proceeds of issue. That will work if I take the amount. If I take the amount, here I am taking percentage. So the effect is the same. Instead of saying 40,000 into 100 minus tax rate divided by 4 lakh, I repeat, 40,000 into 100 minus tax rate divided by 4 lakh. Instead of that, 40,000 by 4 lakh, what is that number? 10%. Into 100 minus tax rate. Effect is the same. So same formula, whatever we have studied in the beginning, same formula we are applying. So cost of debt is equal to 6.5%. Cost of preference capital given in the question 15%. Cost of equity 24%. Therefore, overall cost of capital, we write the formula, multiply and add. 6.5 into 40%. 6.5 into 40%. That is how 2.6 comes up. 15 into 30%. 15 into 30%. That is how 4.5 comes up. 24 into 30%, that is how 7.2 comes up. That's the calculation for you. So the total of these three is equivalent to the overall cost of capital, 14.3%. I will pause for a while, just mentally observe whatever we have discussed in this question, and then we will move on to question number 3. Any queries in this regard, you may feel free to post it in our comment section. Already I have seen and answered a few questions. Very well. We will move to the next learning area. Let's look at the calculation for a question with a lot of information. Let's read the question. Aries Limited wishes to raise additional finance of 10 lakh rupees for meeting its investment plans. It has 2,10,000 rupees in the form of retained earnings available for investment purposes. The following are the further details. Debt equity mix should be 30:70. Cost of debt before tax up to 1,80,000 it is 10%. Beyond 1,80,000 it is 16%. If you borrow up to a particular limit, you have to pay 10% interest. If you borrow more than that, you have to pay 16% interest. Earnings per share is equivalent to 4. Dividend payout is 50% of the earnings, meaning 50% of 2 rupees is the dividend per share. Expected growth rate in dividend is 10%. Current market price per share 44 rupees. Tax rate is equivalent to 50%. you are required to calculate four items. Pattern for raising the additional finance. Pattern for raising the additional finance. Which combination we have going to raise? What is the post-tax average cost of additional debt? KD, second question. Post-tax average cost of additional debt is KD, cost of debt. Cost of retained earnings and the cost of equity. KR, cost of retained earnings, is equivalent to KE, is equivalent to cost of equity. Then fourth one is the overall weighted average after-tax cost of additional finance. Overall weighted average after-tax cost of additional finance is nothing but KO. That is the answer. That is the last requirement. I want you to just go through this table. The query has come up as to, can you repeat the debt and equity computation from the ratio? Total 10 lakh is there, is the capital employed in the earlier question, out of which 2/5, 40% is equivalent to debt. So 2/5 of 10 lakh, 2/5, 2 by 5 of 10 lakh is equivalent to 4 lakh. The balance is own fund. Out of the own fund, preference capital is to equity capital 1:1. So equal distribution, 3 lakh and 3 lakh each. So correspondingly, percentage, each number divided by 10 lakh will give you the percentage in terms of weightage. That is the calculation for the previous one. For this question, I want you to first listen and register some points, and then we will look at the answer slide. It will be more interesting if you can register all this in your mind. 10 lakh is the total fund required for sentence. First item in the table, debt equity should be in the ratio 30:70. 30% of 10 lakh, 3 lakh debt. 70% should be equity. That's the basic split. Now 3 lakh debt, second point in the table, cost of debt before tax, 10% up to 1 lakh 80, 16% up beyond 1 lakh 80. So 3 lakh rupees is the debt, will be split into two loans. First loan carrying 10% interest up to 1 lakh 80,000. Second loan, balancing figure, carrying 16% interest. That amount is equivalent to 3 lakh minus 1 lakh 80, 1 lakh 20,000. So this is the way loans will be taken. Now the balance, the other portion is the equity portion, own fund, 7 lakh. Out of that 7 lakh, refer back to second sentence in the question. Already the company is having 2,10,000 in the form of retained earnings available for investment purpose. A very important statement. Available for investment in the sense, this money is available now in cash and bank balances available as such, which you can use for a further investment. It is not already blocked in our existing plant and machinery, existing stock, etc. No, it is money available with the surplus. So out of 7 lakh rupee equity, 2,10,000 will be retained earnings. The balance 4,90,000 will be a fresh requirement of funds. This 2,10,000 represents a bonus issue because it is already available as retained earning. No fresh money is required from the shareholders, whereas the balance represents a rights issue to existing shareholders. We will take it on that basis. We assume that our existing shareholders will be given the first priority. It becomes a rights issue. So, having told you this much, I'll go to this slide, the second part of the answer part of this question. I'll go to this slide so that you will be able to connect with this better. So let's have a look at this slide. Total funds requirement is equivalent to 10 lakh, split into debt and equity. 30:70, so 3 lakh and 7 lakh. Loan amount, this 3 lakh will be split into two loans as per the question because interest rates are different. First loan 10% interest rate on 1 lakh 80, 18,000 is the interest. Second loan, balancing figure, 3 lakh minus 1 lakh 80, 1 lakh 20 at 16% interest amount is 19,200. So total interest paid is equivalent to 37,200. Total interest paid is equivalent to 37,200. Along with that, I compute the cost of debt. Interest into 100% minus tax rate divided by net proceeds of issue. Now look at what I am doing here. I am not taking the interest rate of 10 and 16 because this is on one number, this is on another number. So I take the total interest amount 37,200, 18,000 plus 19,200 into 100 minus tax rate divided by total amount raised, net proceeds. So 3 lakh rupees. The cost of debt comes to 6.2%. This incidentally gives me the answer for the second requirement. Second question is compute the cost of debt. This is the answer. That is also obtained. Now we will go to the other side. Out of 10 lakh, 3 lakh is debt, 7 lakh is own fund. This is further classified into already available reserves and surplus plus fresh funds. This is called as a bonus issue. That is called as a rights issue. Now the next question, issue will be made at what price? Very simple answer, issue will be made at the current market price. Sir, why should issue be made at the current market price? What is the reason for that? Very simple logic. Shares are like any other item which are bought and sold. Therefore, people are ready to pay 44 rupees for my company share. So I will issue the share at 44. I am the company. People are ready to buy. There is buying, trading happening in the market at 44. So I will issue it at 44. Theory. Practically, what will a company do? It might issue slightly less than the current market price. Practically, say 42 rupees. Just to tell the shareholder, instead of buying from the secondary market, I am respecting you, I am regarding you, I am rewarding you. Therefore, please subscribe for the fresh issue. So consequently, the shareholder will be willingly subscribing because it is slightly lower than the current market price. So this is the practical factor. But examination, we go by theory. Current market price will be the issue price 44. Now, face value out of this 44, face value is equivalent to assumed is an assumption. Face value is equivalent to 10 rupees. The balance 34 is considered to be securities premium. Balance 34 rupees is considered to be securities premium. Sir, why should you assume face value to be 10? Why can't we assume say some other face value and say discount? One fact is that discount is not permissible under company law. Issue of discount is not there. But there is also another concept called logic. There is also another concept called logic. Visualize the possibility. Refer to question. I will go back to the question again. Company is earning profit 4 rupees. Company is declaring dividend 50% of earnings. Company is expected to grow. Company is expected to grow. Such type of company, share will not be quoted below par. It will be quoted above par. Such type of company, share will not be quoted below par. It will be quoted above par. Therefore, par value taken as 10 rupees, securities premium taken as 34. This is an assumption. Sir, can't I assume par value 40 rupees, securities premium 4? Perfectly okay. Absolutely no problem. Sir, par value 25, securities premium 19. Very good. No problem. Whatever you assume, please state that. Then comes the number of shares to be issued. 2,10,000 divided by 44 rupees. That's the issue price. You should not divide by face value. You should divide by the issue price. So consequently, 4,773 shares in this case and 11,136 shares in the second case. This will be the bonus issue followed by the rights issue. This will be the order. So this is the answer to the first part of the question. I will pause. You can absorb all these points. Make a quick note. Many of you will be noting all this. So you can note down along with the proper understanding of how are we going about and why we are going about like this. Why are we taking current market price as the issue price? You can't put another price. People are ready to buy, ready to pay 44. If you offer at 50, people won't buy because they are ready to pay only 44. Sir, I will offer at 30 rupees. People will have doubt. If the normal price is 44, why are you deliberately operating at 30? Something wrong maybe. That element of doubt will be created in the investor's mind. So the company should not cause the doubt. Therefore, practically, we will be offering slightly below the current market price on the practical side. But from examination perspective, it's only current market price as it is. All these concepts are of very simple logic, easily understandable, and highly elementary. We should have a very open mind to receive all the concepts and to remember all these and use it very effectively in the examination. The idea is to have a very open mind to receive all this. Right. Fine. We have completed the pattern for raising the additional finance and also how to compute the cost of debt, which means the first and the second question is taken care of. Pattern for raising the additional finance and post-tax average cost of additional debt. Now the third question is cost of retained earnings and the cost of equity. Both are actually same number because retained earnings belong only to equity shareholders. So KR is equivalent to KE. KR is equivalent to KE. Now, cost of equity. How to compute this number? Cost of equity. We have 6 formula. Obviously, we can't use capital asset pricing model here because we don't use that beta and related value. We don't apply the fifth formula realized yield because next year's market price is not given. Only current market price is given. Only current market price is given. So we don't use the fifth formula. We have to use only the first 4. Now, question specifically says growth rate is there. Expected growth rate. So, consequently, first and second formula we will ignore. We will now restrict to third or fourth formula. Third or fourth formula. Right? See how the logic works. Beta not given, therefore 6th out. Next year market price not given, so 5th formula out. Growth is given, therefore first and second out. So we restrict it to 3 and 4. Now, third formula is dividend approach, fourth is earnings approach. We have earnings, we also have dividends. So any one of these can be applied. But if you use earnings approach, you are recognizing only this number. You are not making use of this information at all. Whatever I'm pointing out right now, whatever I'm pointing out right now, you are not making use of that information at all. So consequently, to make use of this information, we have to use the dividend price approach. The third formula will be applied. I repeat, third formula will be applied. So let's look at the computation. DPS1 divided by MPS0 plus G. DPS1, today's dividend is equivalent to 4 into 50%, 2 rupees. Today's dividend is equivalent to 4 into 50%, 2 rupees. Next year, it will grow by 10%. So 10% upward, 2 rupees 20 paisa. 2 rupees 20 paisa. Divided by 44, DPS1 divided by MPS0 divided by 44, the number is equivalent to 5%. This number is equivalent to 5%. 5 plus growth rate 10. 5 plus 10 is equivalent to 15%, a very direct calculation. Very often students commit the error. This calculation is written as 5 and this is written as 10% 0.1, therefore 5.1 or 10% on the earlier number. No, it is not like that. It's a very direct addition. It's a very direct addition. 5 plus 10, 15%. Now, KR is also equivalent to KE. So both numbers are equivalent to 15%. Now, overall cost of capital, fourth requirement. Here there is no preference share capital. So KD into WD plus KE into WD. We do not recognize the retained earnings because there is also part of equity. Therefore, 30/70, when we write that number, that itself takes care of retained earnings also. Debt 6.2 into 30%, equity 15% into 70%, multiplication and addition, overall cost of capital is equivalent to 12.36%. Overall cost of capital 12.36%. This is the calculation pertaining to KO in this case. We have a few learning points. We have already heard that issue price will be equivalent to current market price. We have already heard that bonus issue comes first, followed by the rights issue. bonus issue first, followed by the rights issue. I have one more information which is relevant in the context of accounting, but which we can understand for our purpose here. The journal entry for bonus and rights issue. I'm just picking a small information from accounting. I am not writing the exact journal entry, I'm just writing the net effect of all this. For a bonus issue, cash inflow is not there, so we'll be debiting reserves and surplus and then crediting equity share capital to the extent of face value, crediting securities premium to the extent of the premium element. For rights issue, we'll be debiting bank towards money received, crediting equity share capital towards the capital face value, and securities premium towards the balance. Now, why are you talking about this entries, sir? What is the significance of all this? Now, you debit reserves and surplus, that is P&L. You also credit securities premium, which is also again reserves and surplus only. This is where it is shown in the company's balance sheet. Why are you debiting reserves and again crediting reserves? What is the significance of this? Very simple answer. If it is available as P&L balance, it is available for dividend distribution. It is available for dividend distribution. If it is available in the form of securities premium, to that extent money is safe. It will not go out as dividend distribution. Money is very safe. It will not go out as dividend distribution. So for protecting the company's fund, so very nice significance. Then another point, money is received 4,90,000. Bulk of this 4,90,000 goes into reserves and surplus, securities premium 378. Sir, as per company law, reserves and surplus can be used for only specified purpose. The money that we have obtained as the securities premium, can it be used for purchasing new fixed assets? Can it be used for purchasing new material, etc.? Yes, very much yes. Law does not say don't use this bank balance. Law says the securities premium account should not be used for other purposes, that is on the liability side of the balance sheet. Here, the asset purchase is not out of, wrongly it should not be understood as asset purchase out of securities premium. Asset purchase is out of the money that we have raised by way of share capital. Law does not prohibit any of this. You can very confidently use that for your business purpose. So we have learned all these related points in this area. Please ensure that you gain this knowledge and understand the significance of the intention of law and the significance of the passing of this entry here, rather than holding this in P&L account. We are protecting the money. It should not go out as dividend. We are holding it in the company and we are trying to have this under our securities premium and equity share capital account, which is not available for distribution as such. This is the underlying idea. So I trust that you would have understood this point. We will now move to the next concept. We will do a small calculation pertaining to the application of KO formula. Application of KO formula. So let's have a look at this first. Hardy company has an overall cost of capital of 15.54%. Its capital structure mix is 30-40-30 for equity preference debt. 30%, 40%, 30%. Check up that the total is equal to 100. Yes, 30-40-30. Equity preference and debt. Preference shares carry 15% dividend, KP 15%. Debt has to be serviced at 12%. Debt has to be serviced at 12. Very good. Interest rate is equal to 12%. The company pays tax at 35%. Company pays tax at 35%. Calculate the cost of equity capital. Calculate KE. Now, the first sentence says our overall cost of capital is 15.54. Our capital structure mix is 30-40-30 for equity preference and debt. Preference dividend rate is given. Interest rate and tax rate are given, from which you can calculate KD. So balancing figure, if you apply the formula, fill up all the numbers, balancing figure is equal to cost of equity capital. A very simple computation in this. I will show you the calculation here. First step is to compute the cost of debt. Interest into 100% minus tax rate. 12 is the interest rate. 100 minus 35, result is equal to 7.8. Then we write the formula for KO. KD into WD, KP into WP, KE into WP. Every number in this equation is available except for KE. We substitute each number. First sentence, KO 10.54, cost of debt 7.8, equity preference debt. Observe the wording very carefully. Equity 30, preference 40, debt 30 in that order. Incidentally, without understanding that order also, if you write 30, 40, 30 left to right, since debt and equity are on opposite sides of this equation, you can still be correct, but let us be very clear. Equity, preference, debt in that order. So the only missing number is KE. On computing the balancing figure, you will get KE is equal to 24%. A very simple calculation relating to application of the formula. We will do one more calculation involving the cost of capital formula and then move on to the next set of concepts here. Right. Just to draw your attention, we have been discussing for around 2 hours now. We have discussed 3 types of leverage today: operating, financial, and combined leverage. And next we have gone into formula for cost of debt, cost of preference share capital, cost of equity, and the cost of retained earnings. Along with this, lot of small information like what is the rate at which new shares are to be issued, what is the order of issue, why are we crediting securities premium account out of reserves and surplus debit, etc. All these are a lot of knowledge that we have gained in this process. Now let's move on to the computation of or the application of the formula pertaining to cost of capital in one more question. A very simple question. Chaplin Limited has a weighted average cost of capital of 12.68%. Its capital structure consists of equity and debt only 2 items, no preference share capital. If the P/E ratio is 5, interest rate on debt is 12%, tax rate is 35%, find out the company's debt equity ratio. Find out the company's debt equity ratio. The earlier question was to calculate what is the cost of equity. Now this question is how to calculate the debt equity ratio. We will start with the numbers that we know. Interest rate on debt is 12, tax rate is 35. So cost of debt is interest into 100% minus tax rate, 12 into 100 minus 35, 7.8%. One calculation is over. Cost of equity, P/E ratio is 5 times. Therefore, 1 divided by 5, 1 divided by 5. Remember the initial discussion. So KE is equivalent to 20%. KE is equivalent to 20%. Now debt equity ratio alone I have to calculate. I will fix, let ratio of debt is equivalent to D. So equity will be 100% minus D. Debt and equity is the total capital. So debt is D. So 100% minus D is equivalent to equity. 100% minus debt, instead of that I call it as 1 minus D. Observe the solution here. First number as discussed, KD is equivalent to 7.8%. Then KE is equivalent to 20%. Let percentage of debt equivalent to D. So cost of equity is equivalent to, or percentage of equity is equivalent to 1 minus D. We write the equation KO is equivalent to KD into WD plus KE into WE. KO 12.68% is equivalent to 7.8% into D plus 20% into 1 minus D, cost of equity into weightage of equity. The balance part of this is a very simple substitution and expanding bracket, solving and finding out all that. So D is equivalent to, as available in the slide, D is equivalent to 7.32 divided by 12.2, which is equivalent to 60%. So equity should be the balance 40%. Equity should be the balance equivalent to 40%. A very simple calculation. I would pause for a while so that you will go through this and assimilate what is the calculation. In a professional examination, every part, every calculation, every assumption, every thought process has to be properly documented. Please ensure that you write properly and also legibly. More about presentation, etc. in the examination, we will discuss in a different context. We will now move to the next area of learning in this chapter. Next area of learning. First part of learning in this chapter was cost of capital. KD, KP, KE, KR, and KO. First part of learning. Second part of learning, if you will recall, I have told you EPS related concepts. EPS related concepts. The first of these concepts is demonstrated by taking up an illustration. Let us look at this question. AB Limited provides you with the following figures. Profit 3 lakh. This has been asked in the examinations, including final, old syllabus, etc. many times. Profit 3 lakh plus interest on debenture at 12%, 60,000. The moment I read this information now, I understand the earlier line is actually profit before interest and tax. That is what is popularly called EB80. That is what is popularly called EB80. Less interest at the rate of 12%, which means again I understand 60,000 divided by 12% is equivalent to 5 lakh worth of debt, 5 lakh worth of debenture. See, look at the thought process. Then EBT 2 lakh 40, less income tax at 50%, 1 lakh 20. So profit after interest and tax, very popularly called PAT, EAT, 1 lakh 20,000. Number of equity shares of 10 rupees each, 40,000. Number of equity shares of 10 rupees each is equivalent to 40,000, which means 4 lakh is the equity share capital. Earnings per share is equivalent to 3 rupees. Earnings per share is equivalent to 3 rupees. The ruling price in the market is current market price 30, and the price earning ratio, market price divided by earnings per share, is equivalent to 10 times. Now let us confirm one or two calculations. Number of equity shares of 10 rupees each, 40,000. So 1 lakh 20 divided by 40,000 is equivalent to 3 rupees. 1 lakh 20,000 divided by 40,000 is equivalent to 3 rupees. Then price earning ratio 30 divided by 3. I repeat, 30 divided by 3. Therefore 10 times. This is the calculation. The company has undistributed reserves of 6 lakhs. Reserves and surplus 6 lakhs. The company needs 20 lakh rupees for expansion. We need 20 lakh rupees. This amount, that is 20 lakh, will earn at the same rate as the funds already employed. When you pump in more money, you will earn more profit, but at the same rate as the funds already employed. You are informed that the debt equity ratio, by the way, debt equity ratio is debt divided by equity. For correctness, the question says debt divided by debt plus equity. So in this question, it is not debt divided by equity, it is debt divided by debt plus equity. That is what is referred to as debt equity ratio in this question for the limited purpose of this question. Normally, debt equity ratio is debt divided by equity. Normally, debt divided by debt plus equity is called debt to total fund ratio. Debt to total fund ratio, right? But this is the terminology used in the question, so we'll go by that. If it is higher than 35%, it will push the ratio, P ratio, down to 8. Presently, it is 10. It will push it down to 8. And raise the interest rate on additional amount borrowed to 14%. Existing loan is at 12%. Additional loan will be at 14%. Additional loan will be at 14%. Find the probable price of the company's share, market price of the company's share, if the additional funds are raised as debt or by issuing equity shares. Additional funds are raised as debt or by issuing equity shares. So consequently, we will have to do the calculation. How do we go about doing this calculation? Very simple. Find out or prepare a profit statement in the revised scenario. Prepare a profit statement. Find out EPS. Find out EPS multiplied by the P ratio. Multiplied by the P ratio, you will get the market price. Sir, why should I multiply by P ratio? That is what is the formula now. P ratio is equivalent to price divided by EPS. Now I want price. So what do? I will multiply these two numbers. For example, here 10 into 3 equal to 30 rupees. Same way, I will calculate this up to 3 rupees or whatever EPS. Then use the P ratio, multiply and get the market price. This is the structure of my presentation. Now for that, I will have to do some workings. I will have to do some preparatory workings. So first of the preparatory working, I will show that in the next slide. So I trust that you have gone through the content available here. I would like to make some preliminary calculation before we go in for the profit statement. What are the preliminary calculations? Present situation, I identify what is the debt amount. As already discussed, 60,000 interest divided by 12%, 5 lakh is the value of debt. Present equity share capital 40,000. I want you to look at the present column. Present equity share capital 40,000 shares at the rate of 10 rupees, 4 lakh rupees. Present reserves and surplus are equivalent to 6 lakh. Therefore, total capital employed presently is equivalent to 15 lakh. This is the present scenario. I will continue in the present column itself. As per the question, debt divided by debt plus equity, 5 divided by 15, debt plus equity is capital employed, is equivalent to 33.33%. Since it is less than 35, it will be 10 times P ratio. 10 times P ratio. I would also like to do one more calculation because question says if you pump in more money in the business, it will earn at the same rate. I repeat, same rate as the funds already employed. So what is the rate that we are earning now? I need to calculate. So 3 lakh is the profit. I will go back to the slide for your attention. 3 lakh is the profit divided by 15 lakh capital employed. So we are earning at the rate of 20% in the present scenario. This is the first column information. Now I go to the first of the alternative. If I borrow, 20 lakh is the extra money required. So 5 plus 20 equal to 25 lakh. Equity capital and reserves remain the same. So total 35 lakh will be maintained. 35 lakh will be the total capital employed. Now 25 by 35, the P ratio becomes 71.43%. Sorry, the debt to total funds ratio becomes 71.43%. And the P ratio, since it is more than 35, P ratio will drop to 8. Now 20% rate will remain the same. Now this 20% is computed on the new capital of 35 lakh. Therefore, the amount of profit is equivalent to 7 lakh. You have to understand this common sense point. Any businessman will pump in more money into the business only when he earns more amount of profit. More amount of profit. So you cannot end up earning the same 3 lakh after pumping extra money into the business. So on the entire new capital, you will earn at the same rate. So 35 into 20% is equal to 7 lakh. When it comes to the last column, equity, I cannot directly add 4 lakh is the present capital, add 20 lakh. No, I cannot add. I have to consider the total in this manner. How do I have to consider? I have to consider the total as the 20 lakh rupees divided by the current issue price, market price 30 rupees. 66,667 shares only will be issued. Now, question itself says face value is equivalent to 10. Therefore, securities premium is equivalent to 20. Face value is multiplied with the number of shares, and I have put the balancing figure as equivalent to reserves and surplus, so that the total amount comes to 35 lakh. Balancing figure is put in reserves and surplus. Rounding off error is there. Now we calculate the debt divided by debt plus equity. It is 14.29, and P ratio is therefore equivalent to 10 times. P ratio is equivalent to 10 times because less than 35. Same 20% is the return on 35 lakh. Our profit will be equal to 7 lakh. This is a working before I prepare the profit statement. So let's understand this. I will pause for a while. You can go through this, register in your mind. and then we will move to the next slide. If you have any queries in relation to what we have discussed, please put them up or in the comment section so that we will resolve that issue. Right. We will move to the profit statement and then the computation of the company's market price and understand the concept in this connection. So, the profit statement will look in this manner. Present situation compared with debt and equity borrowing, debt and equity funding. The EBIT is as we have calculated 3 lakh, 7 lakh and 7 lakh yearly. Now interest, you have to be very careful. Present interest, no problem, 60,000. Proposed interest, I have marked it very specifically in the first column, first alternative, because it's a very special calculation. I would go back to the question again for this reference. Existing interest is 60,000. The fresh fund is 20 lakh, and on that additional amount, I repeat, on the additional amount, it will be 14% interest. So 20 lakh into 14% is 2 lakh 80. 2 lakh 80 plus existing loan interest 60,000. So total interest 280 plus 60 is equivalent to 3 lakh 40. It's a very special calculation. You should not misapply 14% on the entire amount. It is only on the additional amount. If you're going for equity funding, the number is still the same at 60,000 present interest. Subtract, we get EBT. Apply 50% tax on that, we get EAT. We divide it by the number of equity shares. Now in the last column here, this is important. 40,000 plus 66,667 additional shares which have been issued. So total equivalent to 1,06,667 shares. We divide and calculate the EPS. Present EPS is 3 rupees. If you go for debt funding, we earn 4 rupees 50 paisa. If you go for equity funding, it is still 3 rupees. Same number. Multiply by the P ratio, you get the corresponding market price. EPS into P ratio is equivalent to the current market price. Now, you look at EPS line and MPS line very carefully. EPS line and MPS line very carefully. Which of these gives the maximum EPS and maximum MPS? Alternative 1, that is debt funding, leads to the highest EPS and highest MPS. Therefore, that will be most beneficial for the equity shareholder. Why is it most beneficial? Very simple. We are paying interest at a lower rate. We are paying interest at a lower rate, 12% and 14%. Okay. Whereas we are earning ROCE at 20%. So in such cases, borrowing is beneficial or not beneficial? Very simple, it is beneficial. Therefore, you have to borrow in order to get a big advantage for the equity shareholder. The financial leverage works favorably in this case, and therefore, in this case, debt funding will be very preferable. Which method of funding is preferable? Answer, debt funding. Why is this preferable? Because ROCE greater than the interest rate. Now, what is this concept called? This concept of maximizing EPS. We are trying to increase the EPS now. So, this concept of maximizing EPS is called trading on equity. This concept is called trading on equity, also called gearing effect, also called leverage effect, also called gearing effect, also called leverage effect. It will work only when ROCE is greater than the interest rate. ROCE is greater than the interest rate. So this is the calculation relating to the trading on equity. This is one of the concepts under EPS related concepts. We have one concept how to maximize EPS. This is the question. I will pause for a while. You can mentally go through all this, and then we'll move on to the next question, which gives you the next concept. Right. Let us look at another question to consider the next concept. A new project under consideration requires a capital outlay of 300 lakhs. Money required 300 lakhs. The required funds can be raised in two different ways. Equity shares of rupees 100 each for 100 lakhs and 15% preference share capital for 200 lakhs. We need a total 300 lakh. So 100 equity, 200 preference. Or by equity shares of the value 200 lakh and loan of 100 lakh at 12% interest. One method is equity plus preference funding. The second one is debt and equity funding. Equity and preference, debt and equity. Assuming a tax rate of 40%, calculate the figure of EBIT that would keep the equity investors indifferent to the two options. Indifferent represents equal EPS. Indifference technically means or generally means I don't bother. I don't bother. That is what is called indifference. If I get same EPS under two different alternatives, if I have to decide which is a preferable course of action, I would prefer anything because either way EPS is the same. In the earlier question, if you remember, we would prefer to go for debt funding because EPS is higher. In this case, anyhow EPS is going to be the same. Why bother? Anything can be taken. That is what is called EBIT-EPS indifference point. Question also says, verify your answer by calculating the EPS. Check up what is the EPS. So for this purpose, we will do some small calculations. The calculation run in preparing a P&L statement. A very simple calculation, very effective calculation in fact. All amounts except EPS is in rupees lakhs. Everything other than EPS is in lakhs. Now, let the EBIT, you are aware of the profitability statement. EBIT minus interest is equivalent to EBT, less tax is equivalent to VAT, minus preference dividend is equivalent to residual yield. You divide it by the number of equity shares, you get EPS, right? So first alternative of funding is equity 100, preference 200. Second alternative, equity 200, debt 100. In both cases, starting point, let EBIT equivalent to X. What is the number? We have to calculate. Interest, in the first case, there is no debt, therefore no interest. Second case, it is 12. EBT, X and X minus 12. On that 40% tax, we have to write that properly and carefully. And we should be even more careful in subtracting and writing EAT 0.6x and 0.6x minus 7.2. Subtract preference dividend. Subtract preference dividend. In the first case, 200 into 15% is equivalent to 30. In the second case, there is no preference dividend. So balance is equivalent to residual earning. 0.6x minus 30 in the first case, 0.6x minus 7.2 in the second case. This is in lakhs, my dear friends. The question says the face value per share is equivalent to 100. So 100 lakh divided by 100 rupees, 1 lakh shares in the first case and 2 lakh shares in the second case. So EPS is equivalent to 0.66 minus 30. This is itself in lakhs divided by 1 lakh. Since numerator is in lakh, denominator also I am going to write in lakh. So 1. Second case, it is 0.66 minus 7.2 divided by 2. For indifference point, this EPS should be equal to that EPS. So solve and find out what is x equivalent. So 0.6x minus 30 by 1 is equivalent to 0.6x minus 7.2 divided by 2. Therefore, on solving, you will get x is equivalent to 88 lakhs. X is equivalent to 88 is what you will get. Here it is in rupees lakhs. Therefore, x is equivalent to 88 lakh. Now, the other side, question also says verify your answer by calculating the EPS. So, we will substitute in each equation. Last line 0.6x minus 30 divided by 1. 0.6 into 88 minus 30 divided by 1. The result is 22 rupees and 80 paisa. EPS, my dear people, is in rupees. 22 rupees and 80 paisa. In the second case, 0.6 into 88 minus 7.2 divided by 2. 0.6 into 88 minus 7.2 divided by 2. That gives you again 22.8. So at EBIT of 88 lakh, both the options will result in the same EPS, and therefore the company will not bother whichever option is chosen. Reason, same EPS. This is the concept called EBIT-EPS, indifference point. I will pause for a while you go through this item. Then we will learn the third concept under EPS. We have already learned two. We will summarize that and then learn the third concept also. Okay, we will proceed into the next slide, which summarizes the EPS based concepts for us. First concept is maximizing EPS. What is the name for this? This is called trading on equity. Trading on equity. What is the concept? Use of debt funds, use of borrowing. In a situation where ROCE greater than the interest rate, look at the scenario. ROCE greater than the interest rate. In that case, if you borrow, it will lead to maximizing EPS and MPS. This concept is called trading on equity. This concept is called trading on equity. Second concept, equal EPS of two funding options. This is called EBIT-EPS indifference point. What is the meaning of this? It is that level of EBIT at which two different financing options with different combinations of equity, preference, and debt. Different combinations of equity, preference, and debt give you the same EPS. EPS is equal under both the alternatives. Now, the third concept, we will see a question on this shortly. The third concept is called financial break-even point. What is the meaning of this? Company is earning profit? Yes. Then why is it called a break-even point? Company is earning profit. It is not break-even point for the company. It is zero income for the equity shareholder. Financial break-even point. So what is the meaning of this? Residual income available for equity shareholders is equivalent to zero. Whatever the company earning, it is going only towards payment of interest, tax, and the preference dividend. Nothing is available for the equity shareholder. That situation is called financial break-even point. So the shareholders' prayer will be, let the company earn more than the financial break-even point so that I will have some EPS. That will be the prayer on the lips of every equity shareholder. And there is a formula for computing the financial break-even point. EBIT is equivalent to interest plus preference dividend divided by 100% minus tax rate. Now, you should remember the formula very carefully. It is not written as financial break-even point equal to, no, EBAT is equivalent to, because we are talking about EBAT there. So EBAT is equivalent to interest plus preference dividend divided by 100% minus tax rate. Now another immediate query might happen. Sir, preference dividend and all, how can you apply 100 minus tax rate? We are not applying, we are crossing. EBAT before interest and tax, before tax rather. Interest is already before tax only. Interest is already before tax. Preference dividend is actually lying after tax. Therefore, we will have to cross it up and bring it above. That is why we say divided by 100% minus tax rate. So please remember the formula very carefully, and we will learn how to apply the formula in question number 8. Just go through the formula exactly. We will now move into question number 8, involving the computation of financial break-even point. Have a look into the data available before you. The data relating to 3 companies is given below. All the companies are in 35% tax bracket. Compute the financial break-even point for each company and verify your answer in each case. Sir, compute the financial break-even point for each company. What do we do? Apply the formula. Okay. Verify your answer in each case. Prepare profit statement. You will find EBAT minus interest is equivalent to EBT, less tax is equivalent to EAT, minus preference dividend is equivalent to residual earning. You will find residual earning is equivalent to 0. Residual earning is equivalent to 0. That is what is considered as financial break-even point. Right. So let's also understand one more point here. All the companies are in 35% tax bracket. Fine. What is the total capital employed by company A? Total capital employed by company A. 9 plus 6, 15 lakh of debt, 10 lakh of preference capital, 25 lakh of equity capital. So total capital employed is equivalent to 50 lakhs. 50, 50 lakh. Then what about company B? 30 plus 10, 40 lakh of debt, 10 lakh of equity. So again, 50 lakh of capital. Third company, what is the capital employed? 20 lakh of preference, 10 lakh of debt, 10 lakh of equity. So again, equivalent to 50 lakh. All the 3 companies have the same capital employed. I want you to remember this because at the end of it, I will tell you a concept. At the end of it, I will tell you a concept so that you will be able to connect it. So what we are going to do is to compute the financial break-even point by applying the formula. Considering the time factor, I would like you to prepare the profit and loss statement and verify whether EPS is equivalent to or residual earning is equivalent to 0 in this case. That part of the calculation, a very simple calculation, I will leave it to you. You can try it at your end. We will concentrate on the computation of the financial break-even point by applying the formula. So, first case, let us look at the formula involved. EBIT is equivalent to interest plus preference dividend divided by 100% minus tax rate. Company A, we have to calculate interest. Very, very simple calculation. 9 lakh into 15%, 6 lakh into 18%. 9 lakh into 15 is 1 lakh 35. 6 lakh into 18 is 108. So total interest is equivalent to 2 lakh 43,000. 2 lakh 43. Preference dividend 10 lakh into 15% divided by 100 minus tax rate. If you calculate that number, add 2 lakh 43 towards interest, the total EBIT, Please observe that I am not saying total break-even point equal to no. Total EBIT at the break-even point is equivalent to 473,769. Second company, 30 lakh into 12% and 10 lakh into 16%. I am drawing reference to the previous table, previous question, previous slide for the question. 30 lakh into 12%, 10 lakh into 16%. There is no preference capital here. So total, the interest component itself is equivalent to the break-even point value. EBIT should be equivalent to 5,20,000. Now third company, no debt but only preference capital. 20 lakh into 12% divided by 100 minus 35. The number is equivalent to 3,69,231. So this is the value financial break-even point. Just to repeat, this 473, 520 and 369 are all EBIT levels. Are all what numbers? EBIT. EBIT is equivalent to this value. When you prepare the profit statement, start with these three numbers as EBIT. You will get residual earning is equivalent to 0. Residual earning is equivalent to 0. You may prepare the profit statement to verify nil EPS. You may prepare the profit statement to verify nil EPS. I will pause for a short while. You can go through the calculation and observe the procedure involved and how the formula is applied. And remember that it is EBIT at the financial break-even point. EBIT at the financial break-even point. Certain terms, if we learn them and remember them properly, we will be avoiding a lot of unwanted mistakes in the course of our practice and in the course of our examination. For example, I had talked about dividend rate and the dividend yield in a prior situation. Now this number 473, 520 and 369 are all EBIT levels at the financial break-even point. So remember this point so that you can prepare the profit statement and compute zero residual earnings. Now, before we go to the next one, I would like you to answer one more question in this, one more aspect in this. 473, 520, 369. These are the EBITs. These are the levels at which the company earns some money for the equity shareholder, or company does not earn anything for the equity shareholder. What is the meaning of these numbers? I would like to see your answer on this. I would like to get your answer on this. 473, 5,20 and 3,69. These are the points, these are the levels of income at which equity shareholder is able to generate any money, any EPS for him, or he is not able to get any money. Please note, company is earning money. Whether equity shareholder is getting money or not, that is the issue that we would like to address here. So what is the answer to this question? Is it not sufficient if the company earns money? No, it is not sufficient. Equity shareholder is the last person in the queue. He should be satisfied. Sir, every person in the queue should be satisfied. Why are you telling only last person should be satisfied? Very simple logic. You are taking care of people only in the queue order. So if the last person is satisfied, it means every person before him has been satisfied. So we look at the satisfaction level of the last person, namely the equity shareholder. So these 473, 5,20 and 3,69 are the levels at which equity shareholder will get any profit, any EPS, any residual earning. Well, the answer is no, he won't get anything. So he will be sincerely praying, let the company earn more than these incomes. Only then I will get something. This is the equity shareholders' prayer. So why are you telling all this? Now I will also have to calculate or identify which company is more risky. Third company, if it crosses 369, equity shareholder will have some residual earning. He will be happy. I am also earning something. First company has to cross 473. Only then equity shareholder will be getting some residual earning. Second company B has to cross 5 lakh 20. So equity shareholder will be biting his nails and sincerely expecting when the company is going to cross, tension, anxiety. When the company is going to cross 5 lakh 20. When is he going to earn that? When is the company going to earn that? Only in that case, I will have some business. I will have some business. So, equity shareholder will be finding company B to be very risky because not getting any return. Not getting any return. Right? So, you are very right in the answer. At these levels, equity shareholder will not get any money. Company is earning, but everything is for satisfying the previous people. I am not getting any money. And in company B's case, I have to keep on with tension, anxiety. I have to always look at when my turn will come, when will the company earn money and all that. So company B is most risky for the equity shareholder. Company B is most risky. So why are you giving all this explanation? Back to the earlier slide, I will tell you what the concept is. This company B is more risky, we are telling now, for the equity shareholder because that company has got the maximum debt. Third company has not borrowed at all. Equity shareholder is very happy. First company has borrowed only 15 lakh. This company has borrowed 40 lakh. So maximum borrowing by the company or more and more borrowing by the company creates a risk for the equity shareholder, biting nails, tension, anxiety and all that. Creates a problem for the equity shareholder. Look at the two extremes that we have discussed now. On the one hand, we say you borrow, only then leverage will work favorably, and therefore you will be able to maximize your EPS and LPS. We call this as trading on equity. We put it one side. On the other hand, we say if you borrow more, tension and anxiety for the equity shareholder, so think twice before borrowing. So we are giving both the answers. Or should you borrow? Yes, trading on equity, leverage effect, borrow. Again, should you borrow? No, no. If you borrow, equity shareholder will have big risk. Therefore, think twice before borrowing. So there is a need for balancing whether to borrow or whether to go in for own funding. Whether to borrow or whether to go in for own funding, there is a need for borrowing. This is explained in the concept called capital structure theories. We now come to the last part of this chapter, namely capital structure theories. There are four theories, four concepts which explain what should be the best combination of debt and equity. What should be the best combination of debt and equity? The capital structure theories have two objectives: minimize cost of capital, maximize the firm value. I will repeat: minimize cost of capital, maximize the firm value. Sir, why these objectives? Very simple. Recall financial management introduction, yesterday's discussion. Two aspects of financial management: getting money and using money. Getting money, nobody gives funds free. We have to incur cost. So minimize the cost. That is the objective here. Minimize cost. Value maximization is from the company and investor viewpoint. Therefore, maximize the firm value. Maximize the firm value. That is the philosophy. So minimize cost, maximize the firm value. These are the two objectives. These objectives are based on certain assumptions which we are going to have in capital structure theories. For example, we don't recognize preference shareholder, only debt and equity. For example, another assumption, we say that there is no tax, easier to handle. Another assumption, There is no retained earnings. Every money is distributed to equity shareholders. Whatever balance we have after paying interest, entirely paid to equity shareholders. So we have all these assumptions, and based on those assumptions, we have four theories: net income theory, net operating income theory, traditional theory, and the Modigliani Miller theory. Now, what are these four theories? I'll give you a small idea, then you can go into the further slide in this connection. There are actually three philosophies: net income, net operating income, and a traditional approach. Modigliani and Miller approach is a refinement of the net operating income theory. Underlying principles are the same, but with extra postulates, extra propositions, extra statements. So, refinement of the net operating income approach. First approach, net income approach says your financial leverage is always going to be favorable. Therefore, borrow more. Therefore, borrow more. If you borrow more and more, overall cost of capital will get reduced. If you borrow more and more, overall cost of capital will get reduced. So why will overall cost of capital get reduced? Because weightage of debt increases. Debt is cheaper than equity. Debt is cheaper than equity. Therefore, you will be able to reduce your overall cost of capital. Go for maximum borrowing, net income approach. Go for maximum borrowing. Second approach, net operating income approach says, if you borrow more, okay, cost of debt alone may remain the same, but cost of equity will increase. Why will cost of equity increase? Because equity shareholders are standing behind in the queue. Queue length increases by putting more people before. More debt means I am the equity shareholder. More debt means more people come and join me before in the queue. So I am pushed back further. So my waiting time increases. My risk increases. Remember again, biting nails, tension, anxiety only. All these are to be considered from the equity shareholder's perspective. So if you borrow more, you may say debt is cheaper, but equity's cost increases. Therefore, you say you have advantage in debt, you have a disadvantage of increase in cost of equity. Advantage of debt, disadvantage of increase in cost of equity. Therefore, they set off each other mutually. Therefore, cost of capital remains constant. Cost of capital remains constant. Net operating income approach says debt is cheaper, you may borrow, but if you borrow, cost of equity increases, therefore overall cost of capital constant. Net operating income approach. Traditional approach says is the more practical approach, even though the word traditional should not be misunderstood. Old is different, traditional is different. Old means applicable long time back and it was used there. Traditional, established long time back and till now being successfully implemented. That is what is called a traditional approach. In the practical world, the traditional approach is what operates. Traditional approach says you can borrow to some extent, but not too much. If you borrow initially, financial leverage will be favorable. You can save, you can bring down the cost of capital. But beyond an extent, cost of debt will also increase, cost of equity will also increase, KO will also increase. So do not over borrow. Do not over borrow. Borrow only up to the optimum level. Borrow only up to the optimum level. This is the traditional approach. So net income approach says borrow maximum. Net operating income approach says whether you borrow or not, anyhow cost of capital is going to be constant. Anyhow cost of capital is going to be constant. Traditional approach says borrow, but up to the optimum level, do not go beyond that. These are the three theories. Modigliani and Miller is a refinement of the net operating income approach. We have further postulates in Modigliani and Miller pertaining to the calculation of cost of equity, how overall cost of capital remains constant, etc. Please go through all that carefully at your end. We will now quickly consider in the balance time two illustrations pertaining to net income approach and net operating income approach. This question number 9 is on net income approach. A company has an EBIT of 2 lakh rupees. It has a long-term debt of 2,50,000 at 10% interest rate. EBIT is 2 lakh, long-term loan is 2,50,000 at 10% interest rate. The equity capitalization rate of the business is 18%. Equity capitalization rate is nothing but KE. Assuming that there are no taxes, compute the value of the firm using NI approach, NI net income approach. By what extent is the firm's market value affected if the firm borrows 5 lakh to repay equity capital? 5 lakh rupees borrowed in order to repay equity capital. Remember, net income approach advocates borrow more. So what will be the impact? The value of the firm will increase. Value of the firm will increase. That is what we have got to calculate. I will show the computation. Along with that, some extra explanation to understand what happens to equity capital, shareholders, etc. Now let's look at the solution. Up to whatever is available in the table before you, that is the solution. After that, I have some extra analysis to help you understand the proper perspective of this theory. The calculation is split into two situations. Present situation compared with proposed, that is more debt. First 3 lines, profit statement, EBIT minus interest is equivalent to EBT. We then calculate the value of debt, value of equity, and also value of the firm. Now these are all some standard formula which we use in this context, which within the time available, I will not be able to go through, or I will not be able to explain the logic in this regard. This KE and value of equity, very simple, KE is equivalent to EAT divided by equity. So correspondingly, equity value is equivalent to, it is calculated on rotation basis in this manner. We rotate the formula, we get the other number. So this is the calculation, but I am not going into the further details there. Why are we not considering tax? It is one of the assumptions. Why are we not considering preference capital? That is also one of the assumptions involved in capital structure theories. So 2 lakh minus 25,000 interest, 1,75,000. Debt amount is equivalent to 2,50,000. Equity amount, please note, this is the value, market value of equity, not balance sheet amount, market value. Our idea of increasing value is not to increase the balance sheet total. That is not the objective. Our idea is to increase the market value, firm capitalization. That is our target. So EBT 1,75,000 divided by 18% KE is equivalent to this value. So value of the firm is calculated as 12,22,222. From this, we compute the weighted average cost of capital, which in this case is equivalent to 16.36%. Now, if you borrow more, 2 lakh will be your profit. That will be the same. Now, 5 lakh rupees extra borrowed, 2 lakh 50 plus another 5 lakh, 7.5 lakh loan into 10% interest. The corresponding computations result in a higher value of the firm and reduction in the weighted average cost of capital. This, my dear people, is the net income theory. If you borrow more, your value increases 1222 to 1444 and weighted average cost of capital reduces. Now a related point, you look at 972 versus 694. You look at 175 versus 125. If you look at the amount, it will create an impression as if equity shareholder is having a disadvantage. Lower amounts are 175, 125, 972, 694. So equity shareholder is having a disadvantage. It will create an impression. But actually, it is the other way around. Equity shareholder is in fact bursting with happiness. Now, what is that bursting with happiness? Let's assume that capital employed is 10 lakh. With that, present debt is 2,50,000 and equity should be 7.5 lakh. The proposed amount will be exact ulta because we are borrowing to repay equity capital. Now, assuming 100 rupees face value, the number of equity shares is 7,500 and 2,500, which means The market price per share is 129.63 and 277 in the revised situation. Look at how happy the equity shareholder will be. From 129, it goes up to 277, right? More than double. I'll be a very happy person if I were this equity shareholder. EPS in the reverse situation from 23.33, it goes up to 50 rupees. It goes up to 50 rupees. So again, it's happiness for the equity shareholder. So do not look at the amount of EBT or do not look at the amount of the value of equity. Look at what is per share EPS. What is per share? What is the market price per share? That will give you a better perspective of understanding the net income approach. Right. So go through this very carefully. It's one of the illustrations that we have in demonstrating that trading on equity, the same principle, remember, trading on equity works favorably when you borrow more, and that is what is accepted by the net income approach. And if you look at the total amounts, it might create a different impression, and therefore you should understand the context properly by comparing it on a per share basis, market price per share and earnings per share. If you compare in that fashion, you will be able to understand the real intent of this thing. So with that, we will conclude today's session. We have discussed enough in relation to the various costs of capital, debt, preference, equity, and all that. We have learned something in connection with three types of principles under EPS. One is maximizing the EPS. The second one is having equal EPS of two different funding options. And the third one is to have no EPS at all. Third one is to have no EPS at all. So three different situations we have considered, and we have also talked about the four types of theories. Four theories. Out of these four, Modigliani and Miller and net operating income theory say cost of capital is a constant number, whereas net income approach and the traditional approach say cost of capital, overall cost of capital will not be constant. Net income approach says it will keep on reducing if you borrow again and again, whereas traditional approach says you can borrow but do not overdo it, keep it at the optimum. So these are all the various aspects that we have discussed today after discussing leverage concept. So we'll stop with this and we will continue further matters in financial management in another session. I request the organizer to take over and thereafter close the proceedings.
Thank you so much, sir. It was again a wonderful session. Thank you to all the students who partook in this session. And one more thing, students, you can share this with your friends as much as possible. Those of you who attended yesterday's and today's can continue tomorrow's session also. At the same time, from 6 p.m. to 9 p.m., we are coming live. Join us live. And for those friends who missed this out, share the links with them. Today's video and yesterday's video are always available in our YouTube channel. You can share that with your friends so they can attend that and join us live tomorrow also. All the very best to all of you. Hope you all enjoyed this session. Thank you so much to CA Saravana Prasath sir for taking time out of his busy schedules and preparing a session for us like this. We meet you all in tomorrow's live session. Thank you so much. Thank you.
Thank you and good.